central banks around the world, both developed and emerging, are fighting inflation.
I really think it's about ECB policy, how that relates to Fed policy and this U.S. dollar.
The consumer remains strong, so there kind of continues the challenge that the Fed has.
The last mile is going to be hard, but I do believe that we are very much on that disinflationary trend.
I think we're in this very, hold your breath kind of moment.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market slightly negative on the S&P 500. Big events through the next 24 hours. CPI just around the corner tomorrow morning. Before we get there, Apple in focus. TK, the iPhone 15 a little bit later this afternoon.
How many times are we going to hear one more thing today at this thing? We should have all worn black turtlenecks today. That would have made us look better. To me, it's just a big marketing thing. I really don't care, except the Apple experts like Mandeep Singh are telling me this time around you got to care about it.
This equity market cares, doesn't it, given the weighting of Apple on the S&P?
Well, look what Tesla did yesterday. Morgan Stanley comes out and goes, hello, buy me, and Tesla goes up, 10%?
Have you ever seen anything like that? An upgrade on the south side of a mega cap name and a 10% move off the back of it. What's the signal you take from that?
The signal for me is there going to be other companies saying, please recommend us. It's a jumble here. It's Tuesday. Is anything supposed to happen today besides the Apple thing? Maybe not. NFIB comes out, but we're getting ready for this news dump that we get Wednesday, Thursday, and Friday.
Elisa, Tesla this morning, negative, just a touch. We're down. A softer move, mild by 0.6% lower.
Maybe the signal is FOMO hasn't died yet. Maybe the feeling right now is that people feel a little bit lost, like they're not getting it right, and that tech has sort of been the juggernaut that has kept on going, and that you can't really count it dead. So if someone says buy, you do it. And that seems to be what people are doing. I don't know what that says going forward, but that's what it says to me right now.
That's exactly what happened yesterday in a major way. Let's turn to the price action. Futures pulling back just a little bit. We're negative by 0.2%. Into the bond market, yields lower by a single basis point. Your 10-year 4.2742. And in the FX market, the euro here, Lisa, just a little bit weaker against the dollar, 107.24.
So 107 is the new level it's stuck at and we're going to get that until maybe on Thursday. 7 a.m., this is some of the other data that's coming out. The OPEC monthly oil report coming out, and underpinning some of the angst that we have seen recently has been oil. Brent crude climbing to some of the highs that we've seen going back to July of last year. 1 p.m. is the launch of Apple's iPhone 15. And Tom, you mentioned, why do we care? Is it going to be just a marketing event? I think it's more than that at a time where suddenly people want to understand what the next hot thing is in tech, because that's what's driven the entire equity market for the United States so far this year.
I'm a broken record on this. Everybody knows I'm chip-centric, and I believe there are new chips in here. There's new inner guts to the phone, which make it special. I don't know. I'm going to listen to the bulls like Dan Ives at Wedbush. I'm going to listen to the bears saying, slow down. I think we've been fair and balanced on that on surveillance, but we've been here before. And, everybody owns it. Well, let me correct that. Retail owns it. Institutions are a little under-owned in Apple. Maybe this is a thing that makes them buy at the margin.
And we'll talk about whether India owns it as well later on. And today, the Barclays Financial Services Conference is happening in New York. Goldman Sachs CEO David Solomon is speaking at 2:45 p.m., among others, including the leaders of Wells Fargo, Barclays, and Deutsche Bank. I'm just curious to see whether we have any sense of that shift from Goldman Sachs, but more broadly, John, the cuts that we keep hearing about. Is it just the sort of typical fall culling of the herd, or is there something deeper going on, especially given some of the credit concerns?
Looking ahead to earnings already, October 13th for JP Morgan, TK. I know you read that note this morning from Ben Laidlaw.
Yeah.
Next big stop for this market after CPI?
I really agree with this. Ben Laidlaw pointing out there's all this economic data. We're all going to overanalyze it. I think CPI tomorrow is a big deal. Great. He's looking at October 13th when we start the soiree. And let's be honest, he's bullish. And our first guest this morning is someone who's refamed that to a more bullish stance.
More bullish than he was.
No, but, when do people start popping 5,000 as a regular statistic? There's a real hesitancy to get up there near 4,900 or 5,000. How about 5,100? Let's go. Raise it.
Greg Bowdle of BNP Paribas. He was the biggest bear on the street. He was looking for 3,400. He's now looking for 4,150. Here's the quote. The outlook for this year was always predicated on the idea of seeing a recession in the US. I think we've been surprised at the resilience of the data here in America. Greg, I'm pleased to say, joined us right now. 3,400 to 4,150. Let's start there. What do you feel like you got wrong, and why do you think that's going to persist?
Yes, I think there's been three drivers of the market that have helped this outperformance that we didn't see coming this year. One has been the Gen AI story, so that's a much more bottom-up story, so it's linked to tech and the appetite here to chase those names. I think the second one was positioning. We were aware that people were underweight coming into this year, but I think the extent of the chasing of the market that we've seen has surprised us. And the third thing, maybe most importantly, has just been that the data's been stronger than we expected. Us, along with many in the street, we're looking for a slowdown and looking for a recession this year, and it just hasn't manifested. And really, that's a big driver of the unwind of the gravity of the bearishness in our call.
You've reset. You're still looking for a negative market based on this call at 41.50. Where are you anticipating the weakness comes from, given everything you've just told us?
So I really think it is this manifestation of the slowing in the economy. So we know that everyone was looking for a slowdown that hasn't manifested as quickly as we expected, but that doesn't mean that it's not coming. The effect of the massive policy tightening that we've had is going to have an effect on the economy. It's just taking longer to percolate than people thought. This idea of excess savings being run down, we do think that the consumer is going to slow. So I think many of the reasons that we were cautious on the market, we still think a lot of that can manifest. It just might manifest at a slower pace than we'd previously expected.
You've been a complete class act on this reversal. I want to dig into it further, and that it's been led by 7 stocks. It's been led by big tech, among others. Ben Laidler, who's been dead on, a huge bull, says they will reaffirm and stay strong. With your new optimism, your new neutrality, and dare I say you're going to announce today that you're going to 5,000 SPX, are you going to do it with tech as a growth leader?
It's controlled pessimism at this point, I think. I think in terms of market leadership, it's hard to get away from tech. There is this structural growth story. So if we're in an economy that is slowing, albeit at a more gradual pace than we anticipated, then the structural growth stories are those that are going to outperform. The issue with tech is how far it's rallied this year. So I think the story going forwards in tech is going to be about being more selective. So we see certain subsectors in tech, things like semis, that have rallied massively this year, that maybe might pass the baton a little bit over to maybe software or some of the tech infrastructure names.
So I'm wondering about the concepts behind your bear case and your bull case. They follow kind of traditional economics, where bad news is bad news and good news is good news. The bad news being a hard landing, 3,400. The good news being a reacceleration, 4,600. Why don't you think that a reacceleration would actually prompt more aggressive Fed action that could torpedo the market? And in other words, the sort of good news is bad news and bad news is good news. I know that Tom's loving this. But, how much does that kind of come into play?
No, I think it's a really good question, because when we look at the correlation between equities and bonds, that gives us a bit of a window into that question. So you can look at bond ETF, something like TLT, so longer term treasuries, and you see the correlation between equities and bonds really broke down in summer when the equity market rallied, and we've had a pickup again in that correlation, which kind of points to me this idea that equity valuations are again looking stretched relative to rates, and that does raise the risk that if you get a hotter print, particularly in, say, this week's CPI, that higher rates could be a headwind for equities. So I think equities are stuck between a little bit of a rock and a hard place, in that an economic acceleration, if it's too hot, starts to bring rates higher, and that can again compress PE multiples. But a slowdown is really the bear case. I think our bull case is pretty asymmetric. We're not looking for that much upside. We think that upside would be driven more by value stocks and cyclicals. If we have data surprising to the upside, I don't really think that's going to help the names that have outperformed this year and driven the rally so far.
So do you believe in Goldilocks, or do you think that this is people just sort of wishful thinking and picking a point along a progression towards something else and saying, just stay there?
I think it's very difficult just to stay in this benign Goldilocks environment. I think one of the things that we got a little bit wrong this year was just underestimating this kind of piece in the middle. We had an issue with the data last year that it was way too hot. And our view was that data was going to cool and become too cold and take us into a recession. But ultimately, if you go from too hot to too cold, you go through a piece in the middle where things feel just about right. And that's where we feel we are. So we don't think the data is going to plateau here, and we don't think we're going to stay in this Goldilocks environment forever. This kind of controlled descent that we've had in the data, we think is going to continue to deteriorate and will morph into a shallow recession.
My great theme has been corporations will adjust. How linked, based on what you've been through the last 18 months, how linked is economic analysis with the securities analysis of the market?
I think that equity markets are always very linked to the macro. But there are these secular drivers that sit alongside that. When we go and look at any of the large crashes or bear markets over the last 100 years in equity markets, they're all accompanied with a swift economic decline. But that doesn't mean that we can't have these secular themes, things like Gen AI, that drive some dislocation. So I think part of it is the magnitude. When you're in a more benign economic environment, the economy is not necessarily the primary driver for the market. If we do get to a situation around the turn of the year where we start to see negative payroll prints, then I think people's attention will divert, and people's ability to buy into blue sky thinking becomes much more challenged.
Are you allowed to talk about Apple?
We can talk about it loosely. Obviously, I don't.
Let me loosen it up. Let me loosen it up as follows: dollar stronger, China perhaps developing different tastes, nationalism shaping perhaps some patriotism at home away from foreign luxury items. Are multinationals in trouble here with exposure to China?
So I think how I can answer that is think about some of the general themes that we think about in terms of tech. Those stocks are going to be incredibly resilient in a downturn. Why? Because they have great free cash flow and amazing balance sheets. But that also doesn't mean that they are immune from a consumer slowdown. So one of the things that we think will manifest over the next 6 months is that this tightening of rates will affect the consumer. Now, the consumer is obviously, consumer discretionary is your first port of call, but there are a lot of tech stocks that do face the consumer. Ultimately, Apple sells goods and services to the consumer. So will they be entirely immune from a cyclical slowdown? That's the question.
It's like one more thing, except, it's encore une chose. When you're BNP Paribas, you say that. Of course, you say that.
That wasn't a great song as well.
I think
I'm sure that was a song, wasn't it?
Yeah,
sort of like 90s club music. Yeah. All right. Greg, thank you. Greg Battle.
Encore une
BNP
chose.
Paribas.
It's French.
Wasn't sure where you were going with that.
No, we're going to London next week. We ought to do Euro training thing to Paris. We should do the show from Paris.
You want to take the Eurotunnel?
Yeah, the Euro train thing. Yeah, you come
just to
out
Paris and back, or do you want to do something in Paris?
No, I think we do the show.
Okay, with Greg.
With Greg. BNP Paribas.
All right, looking forward to that. Put that on the schedule then.
I can't focus.
Next week.
I can't focus.
Really?
Everton.
I'm shocked.
Everton or Everton? I mean, we got a new focus here at Surveillance on Everton.
It's Everton.
The Merseyside Derby. And they're going to be taken out. 3 guys in Pasco and Wander in 777 in Miami.
The blue half of Liverpool.
Take them out.
And Tom, based on our reporting, I understand this would make it the 10th US-owned club out of 20 in the Premier League.
Yeah.
I find it fascinating because I think they see a real upside in the values of these football clubs. And I'll tell you why. This is the world's game. And if you look at the franchise value of a US sports team, there are so many that dominate the top 10, even though this is the game just for one country, which speaks to the power of this country.
Yeah.
I think that a lot of US-based investors see the Premier League as it. It has become immensely dominant in world football. And for that reason, Tom, I think they see a lot of upside to the value of these clubs.
And Pasco and Wander at 777, they can look at this as like 6-8 years of bolt-on. They sell it to the Saudis, right? Because the Saudis are putting
There's only so many clubs
money.
you can sell to the Saudis. And I imagine they're going to tighten that up as well, Tom. But certainly America.
They haven't won this year.
America owns British football in a much, much bigger way.
Do the guys in Miami take a loss if they're relegated down? Is that a risk here?
Well, it depends if they monetize that loss, right?
I don't know. We're just covering this
but
because
certainly,
our chairman
brand value is going to take a hit if they get relegated. Absolutely. That's always the risk.
Is like
the Saudis ran that risk, by the way, buying Newcastle, and they almost got relegated.
But now they're good.
Yeah. They spent the money. They started to develop the squad.
For the day.
Is that it? Are we done?
We're not done.
Let's talk sports, New York sports.
Our Bloomberg senior management loves Everton.
Is that right?
Yeah, that's how we're
New York sports for a moment in time looked dreadful in the last 24 hours, and it looked like it might get even worse. The first drive, Bills-Jets, Aaron Rodgers going down, and you're just thinking, never mind his season over, Jets season over. Then they won the game. They won the game, TK. It looks like, I understand he's going to get a scan a little bit later today, Tom. It might be season over for Aaron Rodgers.
Yeah, we can make it's not funny, but Hilarian's ready to step in.
I texted Mohammed last night.
He's ready to step in.
As soon as it happened.
See you, Cambridge.
I'm sure the Jets fans thought it was going to be more of the same. Another tough start to the season, but great win considering what happened at the start. From New York City this morning, good morning to you all.
Look, could we touch $100? Of course we can. Are we expecting prices to average above $100 just yet without an outage? No. Things are slowing in the economy, but oil demand is still very, very strong, don't get me wrong. And Saudi Arabia will keep supplies in check to ensure that inventories continue to draw. That's where we are right now.
That's exactly where we are right now. And Rita Sen of Energy Aspect speaking to us in the last week. A new high for the year on Brent crude in the last 24 hours, 91.45. Your price action shaping up as follows this morning, and good morning to you all. WTI crude, $88 and about 7 cents, positive by 0.9%. Going into CPI tomorrow, yields a little bit lower by a single basis point, 427.62. Looking ahead to the iPhone launch a little bit later this afternoon. Tom, equity futures negative here by 0.2%.
It's going to be interesting to see on a quiet economic day, but then the data piles in tomorrow. John, what's the latest zeitgeist on inflation? I mean, I looked at the headline, I get it, oil up and all that, but core is supposed to be, am I right, quiescent? Is that the right word?
Well, you've nailed it. You asked the question and answered it. That is the story. Two stories. Pick your poison. Yeah. Do you trade on headline, being firmer off the back of crude, or core showing signs of progress, Tom?
Yeah.
That's going to be the decision going into Chairman Powell and the Federal Reserve decision next week.
Let's frame all these themes together, but also take a bigger picture. As I've stated, my book of the year is Robert Kaplan's The Loom of Time. I can't say enough about this. It is a chapter across all of the greater Middle East, and always Kaplan has one chapter that is phenomenal. It is on Saudi Arabia. To help us with Brent at 90 and on the reality of Saudi Arabia and $100 oil is Francisco Blanch. He's head of global commodities and derivative research at Bank of America Global Research. Francisco, you nailed oil. You got your 90, 91 Brent as well. The trajectory seems to be to 100, and very clearly that's what Saudi wants, is a domestic reality. They have budget requirements, fiscal requirements domestically. Are we going to see a $100 barrel because Saudi wants it?
It's possible, Tom. I would say there's three things that have been moving oil prices over the course of the last 3-4 months. Supply, and supply. We've had Saudi Arabia cutting production for, as you know, close to a year now. And they started cutting in September of 2022 at around $95 a barrel on Brent. So clearly they want to have higher prices. They're trying to push the market there. What's new in the past few months is that Russia has finally started to align itself with Saudi Arabia and started to take production out. The Russians, after maximizing volume over price, over value for much of the past 12 months, they started to focus on price over volume. And that's a new development in Russia, I would say, in the last few months. And then also we've had a lot of refining issues, Tom. We've seen products, particularly diesel, leading the oil market higher. So those are the three main supply drivers.
One of the great things in Kaplan's book is the new linkage, not like 1986, but the new linkage between Saudi Arabia and China. Can China live with $100 a barrel oil?
Well, I think that the Saudis have always been very cautious about avoiding demand destruction episodes. And certainly, I think they will become cautious again if prices break through $100 a barrel, because as we saw last year with gas, with natural gas, if prices do get out of whack, you can lose a lot of demand. European natural gas demand from industry, remember, is lower today than it was at this time last year, with a 90% decline in prices. So you have to be careful what you wish for. If prices move up too fast, you can end up hurting consumption. And China today, as you know, is the world's largest oil importer by a mile, and is facing a pretty weak economic outlook ahead because of the real estate challenges and the trade war with the U.S. and of course the tech sector also being down. So I think China is not in a great economic position to begin with. So I think OPEC Plus will be careful as prices rise.
Before we drill into the demand side, let's sit on supply just a little bit longer, Francisco. You mentioned a shift in Russia away from volume to price. What's underpinning that shift? Is that well understood before we make a call about how durable that pivot will be?
In my mind, the pivot comes after a very successful program set up by the U.S. Treasury to put a price cap on Russian oil. Remember, the price cap essentially encouraged Russia to export high volumes at low prices. which were then resold, redistributed across mainly India and China and other clients. But more recently, I think the Russians have figured out that the ruble is too weak, that the Russian tax authorities haven't been able to really raise enough revenue, and the macroeconomy in Russia has really deteriorated. And of course, we've seen that with tensions building up within the military and the paramilitary over the course of the past few months. So I think the conclusion that I believe the Kremlin is probably arriving to is that they need more money, and therefore the way to do that is the way to maximize revenue for the Russian tax authorities has been to pressure volumes lower and allow prices to rise. And the price of Urals crude oil, which was trading around $50 a barrel, is now approaching $80, well above the price cap set out by the US and the European Union.
On our screen right now, Brent crude through 91. So, Francisco, let's talk about demand and build on the question Tom asked. It's an important one. Have we seen any sign of deterioration in demand from China, even with that economic weakness?
Well, the August numbers were phenomenal in terms of import increases. We saw China importing 12.5 million barrels a day on average throughout the month. Granted, imports in July were kind of weak, but what we hear from China, and I was in Singapore last week and at meeting all the various energy traders, the main message is that Chinese demand is pretty healthy. And to be honest, you see it in the data. You look at number of air flights, you look at at passenger traffic. Demand's still pretty healthy. What's been weak is industry-related consumption. So think about gas, oil, diesel, and the petrochemical complex. That's been weak. But I think overall Chinese demand is in a better place. I think even though the real estate sector is not doing well, you still have a strong services sector come back after COVID, and that's supporting oil prices in China and crude runs as well. We've seen refineries running a lot of crude oil in China over the course of the past few months. So I think Chinese demand for oil is continues to lead, frankly, the world. Most of the demand growth this year and probably next year will still come from Asia, and China will be the bigger part of that.
This goes against the narrative, which is that China's falling off a cliff, not demanding anything, and that this is entirely driven, that the increase in prices in oil is entirely driven by what Saudi Arabia is doing and maybe on the margins, what Russia is doing. If we don't have that narrative, what would stop oil prices from going higher, especially if demand continues strong from China?
Well, I mean, I think, look, China overall, like I said, is coming back from COVID. If you look at international flights, they're still down 50%. Now, there's been a lot of tension between the U.S. and China over the course of the last few years, right? And for instance, flights to the U.S. remain very, very suppressed. But that's going to have to pick up. And we're also going to see a meaningful increase in China flights to Europe over the course of the next few quarters. So in my mind, I think the Chinese demand story from a services perspective is okay. I mean, GDP in China is not negative. I mean, it's weak, but weak means 4%, 4.5%. That still allows for growth in kind of the same things we did after in the West when we came out of COVID. Restaurants, going to the movies, traveling around. I mean, the Chinese consumers are doing that, and that's supportive of the oil market. And then, of course, to your point, I mean, the curtailments on OPEC have elevated prices, have brought inventories on a downward trajectory, and we expect that to continue. So again, we are targeting $90 a barrel on Brent for next year. That's the current market right now is at 86 for calendar 2024. So there is a little bit of upside in our view from current prices. But I think if you push too hard, the risk is that inflation comes back, and then the narrative that we're going to have peak rates with no recession goes out the window in my mind, right? So I think OPEC has to be considered also about consider the effects on the macro markets, particularly rates and the outlook for a potential recession in the U.S. and the rest of the world.
Hey, Francisco, always a clinic.
Brilliant.
Thank you, sir. Francisco Blanch of Bank of America, speaking exactly to what Marko Kolanovic of JP Morgan talked about yesterday in his note, the potential for the commodity price surge to feed inflation and extend hiking cycles. More on that conversation still ahead. Lindsay Piegza of Stifel from New York City. This is Bloomberg. No drama this Tuesday morning, pulling back just a touch on the S&P 500. We're negative here by 0.2%. Yesterday on the Nasdaq, best day of gains of the month so far. The month's still young. Got a big event a little bit later this afternoon. The Nasdaq this morning, Tom, lower by 0.2%.
And again, played off Tesla. You were talking about it as we went to air, John. I mean, the idea that any given sell-side firm can come out and say, let's go on a ginormous stock like that.
You get a 10% move.
Like we've never seen that before.
Not just any firm, though. Morgan Stanley, not just any analyst, Adam Jonas.
Yes,
which is
true.
very closely followed in the auto sector. But I'm with you. To see a move like that off the back of a single call on the south side is quite something.
And to what Lisa mentioned with Francisco Blanch, the idea of what China's going to do, and I still think there's a conflation, Lisa, of the gloom, the tangible gloom of domestic balance sheet China with what they're going to do in terms of economic output. The answer is most of the people I trust say, their economic output's not going to be that bad.
This might be kind of perverse, but maybe this is the downside of humility, that if people are very aware of what they don't know, someone just says a catchphrase and they say, oh my goodness, maybe I don't know that I should buy. And that's sort of a question of how much rumor really fosters that, John.
FOMO, maybe some FOMO in this market, maybe. In the bond market, 2-year, 10-year, 30-year, shaping up as follows. Your 10-year looks like this going into inflation tomorrow. Down a single basis point, 427.62. A 2-year still in and around 5%, 4.99 on a 2-year in America. Just to finish on foreign exchange, the euro shaping up as follows, going into the ECB on Thursday. A break of 107 in the last week. Had a little look at 106, back to about 107.20. Negative on that currency pair by 0.3%. Yesterday, a ton of dollar weakness against the whole of G10. The dollar bouncing back just a touch this morning. Under surveillance this morning, Apple launching its iPhone 15 model later on this afternoon. And while the majority of new models will still be China-made, India-made phones will also be available on the first day of sale. That will be a first for Apple. Underscores the company's growing use of India as a production base for its iPhones. Comes at a time, Tom, when there's increased tension with the US and China.
And this is not some CEO delegating authority. This is how Tim Cook became Tim Cook. This is what he does best. That was been emphasized. Mandy Singh mentioned that with Bloomberg Intelligence the other day. But to me, it's really something worth watching. Can the labor execute? Can they get out a zillion phones? Is the design there? Is the fit and finish there? Is the perfect Apple liddy cute little, the little cutesy pie box?
Is that what you're calling it? A cutie pie box?
Yeah, and then the kids leave it. They leave it out so that
this feels personal. This feels personal.
Yeah.
Pick a word: decoupling, de-risking, diversifying. What would you say Apple's doing?
Sending a signal to China that we have optionality.
Well, the thing that I find fascinating is that in some ways, Xi Jinping gave Tim Cook a free chance to actually be emboldened and embrace other countries by basically saying you can't use the iPhone if you're a state employee. How much does this give Apple more room to maneuver with de-risking, diversifying, which they had been doing anyway, but they can make a bit more of a show about it just to talk about their prowess globally?
Earnings risk, Tom. Earnings risk. Let's see if this spreads in China. It's my big question in this quarter.
Yeah,
Are we going to see people flocking to Huawei? Does Huawei have the scale to compete with China? Does it have the technology to compete with the iPhone?
I don't think we know on that, but what we do know is there's been this belief for years in every launch, every one more thing moment, the black turtleneck and all that. There's been this idea, OMG, Apple's dead, margins are going to decline. And it just, oops.
Yeah, it didn't happen.
They didn't decline.
Let's sit on margins. This story on labour costs. The United Auto Workers lowering its pay demands to 36% from 40%, so it's a very small shift. Thursday's deadline for a deal with Detroit's automakers is just around the corner. Bloomberg reporting the companies still see the demand as boosting labour costs too high. I'm not surprised by that, Tom. Just a softer stance from 40 down to 36 from UAW reportedly.
I wonder how they pick which one to strike. I'm fascinated by that. Is it like
you've said that a few times.
How many people are on the lot? How many cars are on the lot? Who's, which group of union workers will cooperate with union management? I don't know what the chemistry
I'm looking straight to the White House, TK. I can't wait to see what their response would be if we get a strike.
After the 48 hours they've had with the president now home, I don't know what his response will be. My head's been. I wonder what
based on what he's
President
told us,
Trump's response.
Based on what he's told us, the most pro-union president in the history of this country,
Yeah,
that
but is the
suggest what he
union
should
with
do?
him? Mr. Trump's going to come out and play this strike as
Precisely.
well.
We're going to find out. Final story for you. New York Jets fearing the worst after star quarterback Aaron Rodgers suffered a suspected serious Achilles injury just 4 minutes. 4 minutes into his debut with the team. The 39-year-old helped off the field after being sacked in the first quarter of the Jets' 22-16 season-opening win over the Bills. Tom, this was not how this was meant to go yesterday at all.
Huge response. And, I actually was talking to Paul Sweeney about this in the last hour of surveillance every morning on radio. And, the idea here, football is just ginormous. I mean, the numbers here, it was like the top 30 or top 40 programs last year.
And the good news, we actually were able to see this in New York, Tom.
Yeah.
If you had Spectrum, because Disney
at the last moment,
China got it together and agreed on it. Shock horror right before Monday Night Football. Yeah,
4 p.m. on the commute home as well. Right now, let's pick it up with Lindsay Piegza. This is perfect to come off of Francisco Blanche with $90 oil and the beautiful microeconomics he showed us. Let's continue this forward from Blanche to Piegza. And Lindsay, I want to go to the microeconomics of oil and how it folds into your inflation call. Here at 90, or dare say higher, what's it do to the Piegza inflation forecast?
Well, I think energy costs are one of the big wild cards that the Fed is facing right now. Now, of course, last month we did see headline inflation tick higher. The committee seems to be brushing that off. But if, in fact, we do see these elevated energy costs sustained on a sustained basis, filter down, this could cause a significant reversal in headline inflation, forcing the Fed to take more aggressive action than I think investors are bracing for. Right now, the notion is more of a patient position from the Fed, but the risk, and we've heard this from Chair Powell before, the risk to inflation is significantly to the upside.
Do they become more restrictive, or do they move along the x-axis where longer becomes longer?
I think both. I think the Fed absolutely has more ammunition in its tool belt to continue to raise rates closer to that 6% target, on top of which we could maintain that elevated level for a prolonged period of time beyond even what the market is anticipating. So even higher for even longer could be the scenario for the Fed if we do see sustained heightened energy prices.
Lindsay, it seems like everyone's thinking that we're in this soft landing type of scenario. It seems now a consensus among investors, among economists, at a time where you are seeing subtle shifts. You're seeing labor markets weaken. You're seeing people's pessimism about their finances start to really pick up. Do you start to see some of these signals as a sign that maybe we're shifting into something that's less, auspicious, that's a little bit less benign than what people are portraying it as?
Well, it's interesting that the bar of expectation has been shifted so much lower that when we talk about a soft landing, it's simply maintaining the bare minimum of positive growth. Because right now, the U.S. economy is far from robust. It's still in positive territory, absolutely. But the momentum seems to be shifting, to your point, to the downside. We're a consumer-based economy, and while the consumer remains more resilient than we had anticipated, the momentum is clearly waning as consumers are relying on these temporary factors to supplement their spending. They're drawing down savings. They're pulling out 401k hardships. They're ramping up credit card debt. These factors are unsustainable. And so as we do expect these factors to be tapped out, that's going to provide more downward momentum for the consumer, and by extension, then more downward momentum for the U.S. economy.
And this was a New York Fed survey yesterday that showed that consumers are finding it most difficult to access credit going back to 2013. Do you expect this to play out in retail sales that we get Thursday? Do you think that this is going to be on the table, or do you think that we're going to have to really wait to see whether or not this is truly going to affect growth?
Well, we have to be careful when we're focusing on one data point, the latest data point, particularly when it comes to retail sales, as we have seen a tremendous amount of volatility as consumers dramatically shift the goods and services in their basket on a month-to-month basis. But when we talk about that, that's a broader implication of the consumer recognizing the fragility of their household balance sheet, something that we do when we're increasingly concerned about our financial footing. So it's not necessarily about one data point, but that downward trend of momentum. And keep in mind that consumers have been pulling away, not just in terms of the nominal dollar spent, but shifting away from goods or stuff, increasingly back to that pre-pandemic trend of relying on experiences or services for the vast majority of their monthly expenditures.
One of the experiences, Lindsay's watching Bloomberg surveillance. It's directly folded into GDP. Lindsay, I did an analysis yesterday before the pandemic of Europe up a total of 8% nominal GDP, while America exploded up 24% nominal GDP. 12 months forward, what is that combination of real GDP and inflation? What's the nominal run rate going to be out well into 2024?
Well, let's start with the real rate. I think the real rate is sub 2%. I think the longer term trend for the U.S. economy is about 1.8. You layer on 2-3% inflation in an optimistic world, and we're closer to that 4% range for nominal GDP.
So let's finish where we began, Lindsay, where Tom was asking about oil prices and how that could really change the Fed's trajectory and change the inflation picture. Is there a price of oil where it becomes inhibitory for the consumer, where suddenly it does impede on their discretionary spending in a more material way? Are we getting close to that?
Yes, I think we are. I think right now, as we just talked about, the consumer is on increasingly fragile footing. And again, we use this word resilient for the consumer, but that's in context of what we had anticipated, a more precipitous decline in activity given 500 basis points plus in terms of Fed tightening. But the fastest way to derail the American consumer is sustained heightened energy prices. And we've seen this play out in cycles before. And so if we start to push towards $4 a gallon or over $4 a gallon, that's going to be very difficult for the average household balance sheet to absorb, particularly when we have other costs coming online, particularly student debt payments. When the average household has a difficulty footing a $500 shock on a monthly basis, any type of tweak to pulling away that discretionary spending, be that to filling up the family car or paying down those monthly debts, this is going to have a significant impact on the consumer's ability to spend out in the marketplace and continue to prop up the U.S. economy.
It makes you wonder how many expensive smartphones they'll be buying, Lindsay, this quarter, doesn't it?
It does, absolutely. But remember, that has become less of a discretionary purchase and more of a necessity as of late.
The iPhone 15, TK, necessity. Is that what you're hearing at home?
My variable on this, I've said this, Dan Ives I thought was great on it, huge disagreement on this, is are the phone companies going to help us with our necessity payment? Really, to me, that's the heart of the matter.
Hey, know? Lindsay, thank you. Lindsay Perks are there of Stifel on the latest. Let's get to a survey from Bank of America, their fund manager survey on policy. 6 out of 10 say the Fed is done. Back in July, 9 out of 10 said the Fed is not done. What a difference a couple of months makes, Tom. Just a total mood swing off the back of the CPI data over the last few months.
It's data dependent, and really over the next 12, 15 days, we're going to be as data dependent as ever. I don't have a clue where we're going to be. You can guesstimate it. You can bet on the market about it. What I would suggest off of this weekend is there's a fair amount of gloom out there. I mean, I think, gloom is... I can't say gloom is back in place, but there's enough narratives of gloom.
Based on the tease I'm about to read.
Yeah.
This is a new one. When was the last time we did this? When was the last time we did this? We're going to be catching up with Dr. Hansati, Johns Hopkins, on the new COVID vaccine.
I called Qantas up and I said, get Hansati on, because I'm going to get the booster. And I need Dr. Hansati. I'm
okay, so let's do this. You have an honest and open conversation about whether you should get that.
Yeah.
That's what you should do.
That's why we're doing this.
Okay, great. So this is like your doctor's visit live on.
Yeah, it is. It's live on air.
Radio.
Johns Hopkins. They're the best. I mean, their websites are great. Their rheumatology is world class. I mean, scary, scary good stuff.
Okay. That conversation just around the corner. Yeah. TK with a doctor's visit. We should brand that, Tom.
Yeah, we're going to do a social media thing on it.
Okay, great. All right, cool. All right,
not now, but when I get the shot.
Well, no, we're going to do that next too. We're going to have the conversation.
I've got my comfort dog goes with me. I hold that bill.
You take a comfort dog. Is that actually a comfort pet? A therapy dog?
Yeah.
Okay.
Yeah,
you take that on planes with you?
He's coming to London.
Nice.
Yeah,
you buy a seat especially for him?
Just for him. Thank you, Redo.
That's sweet.
Keeper of the Amex.
And you expense it too.
Sure.
That's good to hear. From New York City this morning, good morning to you all. Equity futures down here by a couple of tenths of 1%. Your iPhone 15 unveiling a little bit later this afternoon.
market is so important because it really supports the consumer spending, and we've seen the labor market cooling off. We should eventually see signs of consumer spending cooling off. There's been downward pressure on inflation, but it's a really tricky needle to thread in terms of doing just enough, but not too much.
So difficult. Claudia Sahm there of Sahm Consulting, the founder and former Fed economist. Looking forward, Tom. You could take that clip, play it all the way through the year. We've just heard it a million times. This is what's going to happen. This is what's going to happen. And it's happening way more slowly, far more slowly than we anticipated.
It's sort of Humility Tuesday. This came from James Dimon talking about he wants primal scream for humility on bank capital requirements. And there's other issues this morning on humility. And Claudia Sam's economics is an economics of humility, where she will make statements, but she hedges every step of the way, particularly on recession.
She's fantastic. Just one of the best at that. Looking ahead to jobless claims on Thursday, retail sales on Thursday as well. Tomorrow morning, we'll get CPI in America. Going into all of that, equity futures just a little bit softer here, negative by 0.2%. No real drama here on a 10-year, 427.82. I want to go back to that quote from Marko Klanovic over at JP Morgan. The risk, the potential for a commodity price surge to feed inflation and extend central banks hiking cycles. That's the call from the man at JP Morgan in the investment bank, Tom, at the moment.
Well, we're going to have to see how that goes. I mean, there's going to be a lot of... but the opinions are going to adjust here by Thursday or by Friday. I mean, Kalanovic is probably going to publish 3 times.
Well, depending on where crude is, but yeah. I mean, he's been pretty bearish on stocks through much of this year.
This is a joy to do this in remembrance of how people stepped up big time in early 2020. I have a clearest memory of our first interview on COVID. It was with an acclaimed radiologist from Mount Sinai in New York who brought into our studios X-rays from China showing the outside lung damage that COVID could wrought. Johns Hopkins helped us so much on this. And joining us now in the booster uproar, Bhakti Hansadi, to say she's Associate Professor of Emergency Medicine, barely describes the global parchments, the study, the academics of Professor Hansadi. Bhakti, great to see you again under always COVID difficulties, to say the least. When we were kids, it was routine to get a booster shot. Is an mRNA booster shot any different, any more dangerous, any more at risk than a tetanus booster shot of my childhood?
Absolutely not. The current new vaccines are not technically boosters, or updated vaccines that are targeted to the current viruses that are circulating, but they're equally safe. These vaccines have full approval, i.e. they've gone through all the scientific rigmarole to ensure that they're safe and effective for the population.
Bhakti, I look at the science here, and it seems in order. I'm basically appalled at the government response, the messaging from the White House to get behind the science community. What do you need from the president? What do you need from the administration to build confidence in this booster program?
So I think we clear messaging. This is full approval, number one. 2, we need to hear from the CDC today. They will be deciding who should get the booster, who do they recommend, but also the reasons for those recommendations. Why is that the current recommendation? And what are they trying to do by making this recommendation? Are they trying to prioritize those at highest risk? Or are they genuinely saying that the vaccine is only recommended for those people it will benefit? So we need clear communication, clear logistical reasons as to their recommendations. And the third is we need to make sure our supply chains are strong. So we need to make sure this vaccine comes out later on this week, that folks know where to go, that folks can access the vaccine quickly and effectively.
How much did the administration and policymakers really set themselves back by trying to clamp down on the message so hard initially? There was just a court ruling saying that the administration did overreach in trying to strip away any anti-vaccine messaging. How do you view that in light of what you're trying to put forward right now?
So we view that because it has this paternalistic attitude to health, right? But we are all informed partakers of our own lives, our own health. We have access to information, some good, some bad, some here, some elsewhere. And so by having communication that is more robust, that is less black and white, that allows for effective dialogue, that allows individuals to buy into the whole the interventions, the vaccines, the therapeutics, the masking. And so what we need is to ensure that there's dialogue, that there is debate, that debate has a scientific foundation.
There's also been a lot of discussion about side effects for the vaccines, in addition to how much they actually prevent you from getting more sick. If you're going to still get sick and you've already had it and you're not going to die, there's this sort of feeling, what's the point of increasing the potential risk if on the downside you could just spend another day in bed? What's your view on that?
Absolutely. So first of all, the FDA would not approve a vaccine where the likelihood of you being sick is greater than the illness itself, right? That is just not going to happen. So the side effects of the vaccine do exist, but they're over-reported, partly due to the media. We over-report rare events that can be dangerous. As far as the illness from COVID-19, it affects different people differently. So if you have multiple comorbidities, you have existing lung conditions, you may in fact require hospitalization. Hospitalizations went up by 8.7%. So it's not as if this disease is a benign common cold where you're just going to spend an extra day in bed. I had the pleasure of treating several patients over the weekend at Johns Hopkins Hospital Emergency Department, and the majority of my patients went home, but some patients did require admission. A lot of patients reported that they were fatigued, exhausted, couldn't go to work, couldn't manage their activities of daily living, couldn't look after their dependents. So if you're responsible for a family, for children, elderly parents, or you need to go to work, then get vaccinated. The chance of you doing that is much greater.
How is this different from the flu?
Not significantly. The flu has the same constellation of symptoms: fevers, chills, colds, congestion. COVID will present the same, as will RSV. And that is the challenge here. COVID illness will likely be underreported because some people may assume that they just have the flu. And that's okay as long as you're staying at home and isolating.
Dr. Ansari, what is the science of masks? I don't want the politics. I don't want the mumbo jumbo. I can't stand them, full disclosure. But what is the science of masks in this COVID of 2024?
The science of masks is when masks are worn, they are effective at preventing onward transmission. A lot of the literature that you're seeing right now misinterprets the data and how the data was collected. A lot of the data is in non-COVID eras, in individuals who are not accustomed to wearing masks. But the data from COVID during masking in healthcare facilities showed that there was very little healthcare worker to healthcare transmission when healthcare workers were wearing masks, even if they were COVID positive at the time. So the science shows that masking works. I also hate masks. My patients feel better when they see my face, they see my smile. I'm able to reassure them during their illness. So I'm choosing who I mask and who I don't mask with. If someone does not have upper respiratory illness or flu-like symptoms or is not immunocompromised, I'm currently, right now, this is today, I'm not masking. In the future, I may change that if COVID-19 cases continue to increase.
We want to see you smiling without a mask. Doctor, thank you. Dr. Bhakti Ansari there on the latest. TK, it's been a while. I love seeing the doctor. Let's hope we don't have to do this too often going into winter.
I just want
I don't
to do
think anyone wants that.
Yeah, I just do science here, and I just want the politicians to be forthright about it. I get that there's a political debate, and there's an advantageous outcome for politicians to politicize science. That's always been the case.
After all these years, why are we still talking about science as if it's definitive and not a process of ongoing study?
It's not definitive. I sat in classrooms in microbiology when mRNA was a pipe dream of David Baltimore and others on the island of Manhattan, Baylor in Texas, mental block. Anyways, there were people with David Baltimore 50 years ago doing this in mRNA, and now it's saving our lives and saving some lives at risk.
The problem is there's nuance. There's data that's better than others. It's very difficult to know. And how do you come up with a public policy at the same time of trying to follow the nuance of science? Did they do it perfectly? There's a lot of criticism. So how do you then form a policy now with public trust that has been impeded in a significant way in certain corners? And it's going to be a real challenge going forward.
Oh, public trust has been shattered. Absolutely
yes, that is
shattered.
accurate. That is accurate.
Big time.
And I would say, am I right, John, less in England where you've got a huge microbiological, Imperial College and all that, you got a real belief in it.
We were lied to on so many fronts, Tom, not just misled. Flat out lied.
Shattered is absolutely the right word.
Stuart Kaiser of Citi is going to join us shortly. We'll talk about markets, less about COVID. Equity futures on the S&P negative here by 0.2%. From New York City this morning, good morning to you all.
Central banks around the world, both developed and emerging, are fighting inflation.
I really think it's about ECB policy, how that relates to Fed policy and this U.S. dollar.
The consumer remains strong, so there kind of continues the challenge that the Fed has.
The last mile is going to be hard, but I do believe that we are very much on that disinflationary trend.
I think we're in this very hold your breath kind of moment.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
In many ways, the week begins today. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market's slightly negative by 0.2% on the S&P 500. Tomorrow, the big data point, CPI, just around the corner tomorrow morning, stateside. Before we get there, later on this afternoon, a much-anticipated iPhone 15 launch, Tom, after a week of weakness from that Apple stock.
Can we try to get Apple tied into the CPI report?
Can if you want, yeah.
UAW strike? I don't think we can.
Higher prices.
There it is. There it is. We're going to see it this afternoon. We've got our full Bloomberg technology team.
Ed Ludlow, Caroline Hyde.
Styling, they're there.
Bases loaded, TK.
It's going to be there. I think they're doing a new iWatch, not getting much traction. AirPods better get traction.
Another set.
Well, we've got an odd set under the couch, so we got to replenish, I think is what
with a new set.
Sets.
Yeah,
plural. You have to have them.
Okay.
I've never owned them, but others, they walk around the house.
You don't use them?
No, I don't use
them. You're still doing old school.
They walk around the house. Afterthought has a set, and
is that
Mrs. Keene has a set.
Is that the family dancing? Is that
vet,
what that?
Yeah, vet.
Body action is. I've no idea what your body's doing right now.
This is vet walking around Central Park.
You consider dancing to be?
Vet Bill's walking around Central Park.
Your body's just sort of pulsing. It's quite distracting. Okay.
I'm getting ready for the music of the
Let's
Apple
talk about the serious element to this story, the serious side of it. There's some new competition in China, Huawei, 1, and 2. There's the government pushing back, TK, pushing back and banning the use of iPhones across certain agencies, certain state employees, and maybe even state firms based on our recent reporting.
Lisa mentioned it earlier. We report today that they're looking at an India phone to be ready day one. I did not expect that. There it is. So, did they mention the politics today? I don't think so.
No, they try and avoid it. But Lisa, the foreign policy of this story is absolutely fascinating for so many people, particularly after the events of the last week or so.
Yeah, considering that about, a fifth of the revenue comes from China? I mean, this isn't insignificant. Whether Tim Cook weighs in, probably unlikely. At the same time, whether he signals something with India, I think that that's a signal people are getting.
Do we get a higher average selling price off the back of a phone that doesn't really have many big improvements?
You've mentioned this. If they get sort of subsidized by pay-as-you-go, can you see that kind of price going up? It depends on what they offer. I mean, this is an increasing staple. So at what point do you push people out of the market or basically say you're not going to resurrect your previous phone?
I take immense issue with this push people out of the market. They have done this perfectly. They got monthly plans. Your phone service can give you a monthly plan. Who pays $1,100 for one of these toys?
It's a monthly payment,
Nobody.
Sure. But it's still a big monthly payment.
I'll go with that. Okay, it's a mortgage payment, a car payment, whatever. But the fact is, this idea of the Apple gloom crew that, OMG, it's $1,100, we're all going to die. There's no evidence that's slowed sales.
I don't know. At a certain point, you could say that $1,200, $1,300. Okay, everyone, great. No, oh my God. Well, people are going to get concerned at $4 a gas for a gallon, and you're at $3.83. You're not that far away. So at a certain point, people are like, "We got a phone. It's fine. It works. Fantastic."
They're going to look at $134 at T-Mobile, Verizon, AT&T. Let's go. Can I get it in red?
Maybe, yeah. Look, I would say this about these big tech firms in their current form, and I've asked this question a few times. When was the last time they had a real cyclical test? And think it through. The last decade. When was the last time they had a real cyclical test in the last decade?
Well, they had one
count the
2
pandemic.
decades ago, but
everyone got sent a check, and a lot of people went and bought an iPhone.
Yep.
Based on
There's
the sales.
No question about it. It's been a hell of a ride.
I'm not sure they've had one.
No,
they're getting one right now in China, potentially, on several
ride.
fronts, and we'll see how it develops stateside. Equity futures on the S&P look like this. We're negative by 0.2%, pulling back just a touch. Yields unchanged, 10-year, 428. Crude, take a look at that, $88 a barrel on WTI, and in the 90s on Brent crude. Lisa, this morning, 91.28.
And we're expecting any minute a further kind of upgrade on the outlook from OPEC. They're putting out their monthly report. Very curious to see how the Saudi Arabia cuts to production and Russia as well is affecting that outlook. 1 p.m. is the launch of the Apple's iPhone 15. Very curious to hear what they have to say about India. And today we do get some words from David Solomon of Goldman Sachs at the Barclays Financial Services Conference in New York. There also are a number of other speakers as well from Wells Fargo, Barclays, Deutsche Bank. I want to hear if they talk about consumer credit and what kind of spending we could see going forward, John.
Stuart Kaiser joins us around the table, head of US equity trading strategy over at Citi. Good morning, Stuart.
Good morning.
Let's talk about inflation tomorrow morning. Am I trading headline CPI or am I trading core?
Core, I think.
Core?
Yeah, core inflation. I think anything that rounds down to a 0.2, the market will take pretty well. If it rounds up to 0.3, which is kind of where our economists are, then, it'd be a little bit of test for the market. But yeah, it's core inflation. And then obviously drilling down to this, non-shelter, core services bit as a secondary look.
Any reason to be excited about share pound next week, given what you just said?
Look, they're going to update the economic projections. So I think that's probably going to be the most interesting. What do they do to the growth forecast? They're probably not going to move the terminal rate, but if they were to play around with that, that would be a big focus. So I don't know that the press conference itself, but I think looking at the economic projections will give you a good idea into how they're thinking about the world.
Kaiser speak is we're fading inflation and we're chasing growth. That's the jargon that someone like you uses. What's the bet on the market now? Have we gotten gloomy across a gloomy August?
We pulled back a bit in August. I think rates rose for not good reasons, which was a bit of a change from earlier in the year.
What's the bet of hedge funds and all the other fancy people? Is there a big bet, OMG, we're all going to die?
Hopefully there's not a we're going to die bet. Look, our core view is modestly positive. I think people are probably generally in that camp at this point. But, valuation's gotten to a level and the performance has gotten to a point where the risk reward just doesn't look great. So I think if people are in the market now, it's with a fair bit of caution. And I think the reaction function of investors is to get out quick if the data starts to deteriorate.
Was Tesla's 10% rally yesterday caution?
Caution? Look, Tesla has these rallies, now and again. So I'm not too concerned about it, I guess. We've had a few of these moments, I think, in the last month or so where the market's moved quite a bit, and it's a very concentrated move, whether it's like high short interest stocks or Tesla or a pocket of the market. And, I think that really just speaks to the fact that people are a little bit on edge, and there's just not a lot of tolerance right now. It's a, ask questions later type market if the news comes in good or bad. And I think that's what you saw with Tesla probably yesterday.
I want to get a sense of where you stand on the bull case and the bear case. Greg Battle is on and saying basically a hard landing would be the bear case and something of a reacceleration would be the bull case. Do you agree, or do you think that there is this sort of perverse reality where if things reaccelerate, that could be the most negative outcome for equities?
Not my view. My view would be good data still good. Jonathan and I were joking about this last week. They call it bad data because it's bad. They call it good data because it's good. This is a nominal growth asset. So I think if you're rooting for growth to slow down, you're probably rooting for the wrong thing, in my opinion. But yeah, so to us, it's a soft landing, reacceleration of growth, I think, is the positive side of this thing. The strength in the economy this year on a relative basis has been the labor market and services spend. So I think that's the part of the market that if it started to weaken, that's where you want to really be careful. We're not of the view that you buy the first sign of weakness in the labor market. I think if you start to see those payrolls come off, you want to be very, very cautious and kind of step back and let that happen. Again, because this is a growth asset, and we're not in the camp of rooting for bad news at this point.
Stuart killed me last week. The team did this big preamble, highly produced segment about bad news, good news, bad news. Stuart just came out, TK, and said, what are you talking about? Good news is good news, bad news is bad news. Stuart, what's interesting, though, this year, and we've had a year of upside surprises in the US economy. We also touched on this, and we've had a growth rally off the back of it. Now, can you make sense of that? That's not what's meant to happen, is it? If you get better economic data, shouldn't I see the rally elsewhere?
Yeah, I would agree with you on that side. I think what happened coming into the year was that growth part of the market was very, very under-owned. Expectations were low. The valuation had gotten washed out in 2022. So you had kind of a perfect storm for a positive growth surprise, pushing people into that space. I think the other part, though, is even though growth has surprised, there is still, generally speaking, a scarcity of earnings growth in the world. And it's those large cap tech stocks in the U.S. that are producing that earnings growth and are producing those positive consensus revisions. So our view is that's really why they've they performed so well. It was evaluation washed out, sentiment and positioning was quite low, and then you got strong consensus revisions helped by AI, and that's why we think that part of the market worked in a positive growth environment.
Whatever your belief is, go back on Bloomberg Digital today and all that Lisa does in the newsletter, and re-listen to Stuart Kaiser. Let's go back and re-listen to Stuart Kaiser. You nailed it. The pro tip is nominal is the way to think about this, and it is a nominal growth asset. And the answer is, if we're still popping 4% nominal GDP, the OMG we're all going to die crew doesn't get it done, do they?
Yeah, look, I think that's where, especially from the earnings side of things, that people got things a little bit wrong. There was a view that earnings were just going to get massacred because the Fed was hiking rates. But when you're putting up, high single digits or low double digits nominal growth, it's hard to get it lower.
Is a simplistic statement. The Fed works in a real rate environment, and Stuart Kaiser works in a nominal rate environment, right?
At least for this year. I said at least for this year. But no, I mean, that's kind of our view on equities this year, is if you were expecting a significant deterioration in earnings, that was very hard to accomplish in a positive nominal growth environment. And I think people kind of got surprised a bit there. The real test maybe next year is, as nominal growth starts to slow, what does that do? What does that do to margins, particularly in the equity market? And we'll have to see. I mean, that's probably 6 months out, and we've got a lot of hurdles to jump before we get there. But that'll probably be a big discussion for 2024.
When do you start looking at oil prices as a potential headwind?
It's a great question, because the oil trade and the China trade, frankly, this year, I think people have multiple times this year tried to take upside shots at that trade, and they've largely been disappointed. Now, finally, we get the oil breakout, and nobody's talking about it. So it's a very sort of perverse dynamic there. But look, I think at these levels, if you can sustain these levels, you start to worry a bit. To your point, gas prices are getting near $4 a gallon. That'll start to flow through to headline CPI, and people start to pay attention to that. So I think at these kind of levels, you're paying attention to it. I think there's probably a view out there that OPEC is trying to keep oil in, call it a $70 to $100 range or something like that on a go-forward basis. And as much as $100 oil hurts, I think if the market becomes convinced that oil is sort of range-bound, that's something you can invest around. You can sort of trade that range. You can forecast that, and it's positive. So look, at this level, you do start to worry about the impact on consumer spend and headline. But, I think if we got to triple-digit oil, that's when you're really worried about what is this going to do to the market.
Not far away, $9 right now. The crude bulls were right in the end for different reasons, I guess. We all thought crude might be up here off the back of China reopening. I'm not sure that we had crude in the 90s with China disappointing on growth. That's where a surprise has been.
The key thing is you can be right for the wrong reasons, and
no one cares about that.
I got a line of trophies where
it's always harder, I think, when you get the macro call right and the market call wrong. Stuart, thanks for being with us.
Thank you.
Stuart Kaiser of Citi, thank you. If you are just tuning in, welcome to the programme. Equity futures here negative by 0.2%. Coming up a little bit later, Bob Michael of JP Morgan Asset Management. We'll speak to him in about 48 minutes. He is bullish on bonds. He's not alone. Matt Hornback, Morgan Stanley, says 350 on a 10-year. Mike Schumacher, Wells Fargo, says 350 on a 10-year. BMO's Ian Lingen sat in Stuart's chair about a week ago, and he said the 10-year was a screaming buy. We'll talk to Bob about that.
Down. He didn't
something like that. Yeah. Do you want to talk Aaron Rodgers, Stu? Do you want to fit in a bit of football? Bills Jets. What was that about?
If you're a Jets fan, did not expect this to happen, then you haven't been a Jets fan for long. I mean, this was the most well telegraphed disappointment in the history of sports.
And then you won anyway.
I mean, that's you know what that means. People are going to have hope for another week and just get disappointed again. But I've been a Jets fan for a long time. This is exactly.
So what's the trade? Fade the Jets.
Yeah, the good news from this is we get to keep our first-round picks. So you have to really focus on the narrow silver lining if you can nestle yourself in there.
Lisa, you mentioned this. He's out for the season. That's presumed.
We don't know.
Potentially.
We have no idea. We are going to find out from the scan.
Where's Mohammed? Sure. Mohammed would know. Probably Mohammed talked to Aaron last night.
Lisa, we know he's out for the season.
Oh, is that that's what people presume.
The problem in football is the season's so short. If you pick up an injury like this, you're not coming back.
Yes.
Yeah. You're not coming back. You've got like 4 months to try and recover.
Terrible.
To try and turn it around. Stuart, good to see you.
Yeah, good to see you. Thanks for the uplifting sports conversation.
Fantastic. Anytime. Well, you won. That's the punchline. AMH is joining us from Washington in just a moment. Bloomberg's chief Washington correspondent. Big conversations to be had down in D.C. Impeachment. We need to talk about the potential for impeachment. Unbelievable. From New York City, this is Bloomberg.
I think it is important to be able to have a dialogue with China and with their leaders. And I think if we can continue to have that dialogue, that's probably the best approach to take right now. Maybe we can make some gains in trade and in some other areas like cyber, and at the same time, obviously, maintain our differences with regards to our military positions, particularly on Taiwan.
Effectively endorsing the position of the president over the weekend. That was the former U.S. Secretary of Defense, Leon Panetta, speaking on Bloomberg's balance of power in the past 24 hours. From New York City, welcome to the program. Pushing ahead to the iPhone 15 release a little bit later on this afternoon, then on to this morning. Rather tomorrow morning, CPI just around the corner. This morning, equities shaping up as follows on the S&P. We're negative by 0.2%, just a slight pullback, a little softer. Yields going absolutely nowhere. Your 10-year 4.28. Drew Mattis and Manulife just writing in. Drew Mattis is looking for 4% year-end on a 10-year, 3.50 by next year. So 3.50 is this number, Tom, getting banded around here, there, and everywhere.
That's a working yield, and we mentioned Ian Lingen with the drama of a screaming buy and all that, but there's a fair amount of debate about this. I mean, it's a range thing, and somebody's going to lose some money on this. I don't know who, but there's as big a debate in the bond market as there is in the equity market.
Well, what's been amazing, even with the likes of MetLife's Drew Mattis talking up 4% year-end, 3.50 next year, Tom, we're still in and around 5% on a 2-year, still in and around 4.30 on a 10-year, just sort of stubbornly maintaining these levels, even though many people have said they're not sustainable.
Well, that's the point. People say they're not sustainable, except they were for decades. Are
we back to the old normal?
In the old days, this was normal, and is a 7-8% mortgage normal? I don't think so. You got a real rate on real estate that doesn't work. But the answer is this is sort of what it used to be like.
Is 7% mortgages still aren't normal? That's just the price right now.
There was decades
Torsten Slog
where,
of Apollo putting this one out over the weekend, Tom. The share of mortgages outstanding by interest rate at origination.
Yeah.
So this is dated data. It's from early this year, but I think it still holds. Below 3%, that's 23% of the market right now, Tom. 3 to 4%, 38%. 4 to 5 is 20. 5 to 6 is 10. Above 6%, only 9% of outstanding mortgages at origination. So the price we're told at the moment, Tom, is around 7, but ultimately, hardly anyone's paying it. They're locked in for a whole lot longer.
Does policy clear this oddity? I don't know.
I'm not sure how it does.
Yeah, I don't know. Because it's not, to be clear, folks, in Europe and particularly in the United Kingdom, you don't have this.
No, different structure.
Because of floating rates.
Different structure. And the fixed rate agreements aren't this long. You wouldn't have a 30-year locked in this way.
A couple of years ago, there was a 280-page jewel by the always brilliant Cass Sunstein. It was called Impeachment. And for all of us, including me, that think we know impeachment, but we don't know impeachment, the answer is Cass Sunstein wrote a primer back before Andrew Johnson and the ballet of the 1860s. Amory Horton joins us now on the 2024 impeachment debate of Washington. Amory, this isn't in Cass Sunstein's book. The Senate and the House, the polarity has to be historically unique, is it?
Well, they're very polarized at the moment, not just Democrats and Republicans, but the House and the Senate in regards to a number of issues. Impeachment inquiry looks to be one of them, as well as also comes to funding the government. If you look at how the House wants to have their appropriation bills tallied, and the Senate, which has had 12 appropriation bills come out of committee, and then we'll be seeing them hit the floor, we're looking at a $100 billion difference. It's going to be very difficult if the House and the Senate are both able to even pass those 12 appropriation bills. The Senate looks like it's moving in a more bipartisan fashion, though, and then it goes to a conference. It's going to be very difficult to see how they're going to end on the same page. The Senate actually wants to spend more than what was agreed upon in the debt ceiling deal struck between Speaker McCarthy and the administration, while the House is looking to extract more in terms of what they're calling fiscal responsibility and trying to cut even more off that deal.
Civics 101 with AMH. Let's do it right now. What this is about is linking a potential shutdown to a potential impeachment, I'm going to call it discussion or debate. How do those two conflate together?
Well, there's this potential impeachment inquiry, which we heard Speaker McCarthy talk about a number of times. He's really being pushed by the far hard right flank of his party. And Punchbowl News this morning, run by Jake Sherman, is saying that this week he is going to discuss this behind closed doors. So he's ready to move and give his promise that there will be an impeachment inquiry into President Biden's son, Hunter Biden, as well as the president himself. Obviously, that would be the impeachment inquiry, Joe Biden. And Speaker McCarthy is going to say that this means the House Judiciary, the House Oversight can continue the work of Jim Jordan, James Comer, in getting the Biden family's bank records. The issue, of course, is, does he have the votes to do this? There's a lot of Republicans in moderate districts that vote for President Biden, that do not want to take this vote, even though the Speaker and a lot of individuals in the Republican Party say this is just an inquiry. But what Speaker McCarthy may be doing is holding and dangling out this impeachment inquiry to get the hard right, the ones that potentially want to see a government shutdown because they're not happy with the level of fiscal spending, to go along and vote for continuing resolution to keep the government open after September 30th. It's a bit of a carrot and stick approach.
The fact that this sort of Hail Mary approach is being floated right now, does that indicate that the chance of a government shutdown is looking more likely?
Well, it depends. If he's successful in this, potentially he will get those votes for a continuing resolution. Also, a continuing resolution could garner a lot of Democratic votes. But does he now isolate those Dem votes if he goes for impeachment inquiry? It's really difficult right now for Speaker McCarthy. I feel like I've said this a lot of times on this program, but this does feel like this is going to be one of the hardest mazes for him to navigate. I think one representative yesterday, Mr. Womack of Arkansas, put it very well. You have an individual, any individual in Congress is saying, I will only vote for this bill or this priority if XYZ demand is met. So you have about 15 Republicans who say they're not going to vote to fund Homeland Security if maybe Secretary Mayorkas is not impeached along with it. So these are the kind of demands he is dealing with in his caucus.
Has his leadership been challenged at all since a number of his health scares and his ability to wrangle the votes needed to get this through?
Not at the moment, but there's a growing number of individuals who are saying they will challenge him if he cannot deliver XYZ demand. Representative Matt Gaetz of Florida is saying that he will vote to have a vote of confidence, to make sure that Speaker McCarthy is no longer Speaker if he doesn't follow through with, say, an impeachment inquiry. So this is why it's incredibly challenging for Speaker McCarthy, and it's even more so challenging because it doesn't have the support of the Republicans on the Senate side.
Anne-Marie, the president any president comes back from abroad exhausted. That's just the rule of the road. There's going to be a rest period for the President of the United States. What's his first order of work, say, Wednesday morning?
I would imagine the president this week is laser focused on what is happening in Detroit, Michigan. We still do not have an agreement between the UAW, the Auto Workers Union, and the big three car companies, and that contract ends 11:59 p.m. Eastern Time Thursday. That means we could see a strike at one or all three auto companies come Friday morning. This is going to be incredibly challenging for the president because obviously he wants to make sure that these auto factories are up. This could have a big impact on car production, on the prices of cars that we've seen recently come down, given the rate of inflation coming down. And it can have an impact on the broader economy. At the same time, he has said he wants to be the most pro-labor union president in modern history. And that would make you think that he is going to want to lean into the support of the UAW. So this is going to be a complicated line for the president to walk. And as of now, there's no contract.
I'm not sure how he maintains that claim without leaning in that direction. Anne-Marie, thank you. Down in Washington, AMH, the latest on UAW, United Auto Workers, making a first move away from this 40% pay demand and dropping it to 36%, the smallest of moves. The Detroit automakers, according to our reporters, Tom, don't think much of the offer at all. That deadline that AMH talked about Thursday night is for nearly 150,000 U.S. hourly workers.
Is this like Disney Charter that before Monday Night Football, are we going to be there Friday, 9 p.m.? Bingo.
What,
deal.
coming in?
Yeah.
You want to do a special?
Yeah, we should do a special. Yeah.
I don't want to come in Thursday night. You can come in Thursday night.
Is it Thursday night or Friday night we come
Thursday
in?
night.
Thursday night, thank you.
Thursday night. We'll deal with this Friday morning. Yeah, that makes more sense. No? Okay. Megan Draper, of Barclays is coming up shortly. Your equity market's shaping up as follows. Just pulling back. Session lows here on the S&P 500. We're negative by 0.3%. Equity market stocks on the S&P just off session lows. We're negative here by 0.25%. Pulling back just a touch on the Nasdaq by 1/3 of 1%. Big event for the Nasdaq a little bit later. The launch of the iPhone 15 in Cupertino, California, later on this afternoon. That's the stock market story. Off the back of a decent day of gains, we look like this in a bond market. Yields going absolutely nowhere. 428.61 on a 10-year. Still stubbornly close to 5% on a 2-year. 499.68. The main event for that one a little bit later this week. Tomorrow morning, CPI in the United States of America. Under surveillance this morning, the latest CPI reading from the US due tomorrow, with expectations that month-over-month prices are rising 0.6% on higher gas prices. Core will hold at 0.2%, according to our survey. How we trade these two stories is going to be interesting, particularly if crude and the commodity rally continues. If you want the latest data in the UK, new data in the United Kingdom shows the highest unemployment rate since 2021 at 4.3%. If you look to wages, wage growth is still close to 8%, Tom, excluding bonuses.
In the
Still
United
running
Kingdom.
at close to 8%.
I did not know that. Wow.
Stunning numbers. Will be very interesting to see how these year-end negotiations go for UK-based companies.
Well, it folds into the UAW story here. My basic perception is Europe and the United Kingdom are radically different than here, and they really have a matter. I defer to the governor of the Bank of England, or I believe Catherine Mann is with Bloomberg today, but the answer is it's different over there. It really matters.
Big time. I'm not sure what Governor Bailey does with that. I want to get you the latest on the IPOs as well. I'm expecting to close its IPO order book early. The public offering is oversubscribed by 10 times, Lisa, according to our reporting. Shares expected to be priced on Wednesday. May come in above the initial range of $47 to $51 per share. Trading, Lisa, set to start on Thursday.
It shows how different it is when you have a business model that makes sense versus a business model that's more speculative. ARM is a solid contender. People want to buy profits going forward, especially in the tech space. Instacart, not so much, right? You're getting a different kind of interest. So the difference between these two point to the discerning features of investors right now.
I take your point that they're radically different, but to me, the whole thing is contrived. They're not selling anything near a majority interest of ARM. It is a contrived marketing scheme to bring money in by selling a little teensy bit of ARM. Thus, you get a 10 times oversubscription? Your 8,000 shares put it over the top. But the answer is, to me, and I'd love to hear from people, email in, tweet in, whatever. To me, the whole modern IPO process is just a joke compared to what it used to be.
There are two things here. There's one about the actual IPO process. There's another about SoftBank wanting to cash out of a small slice, but not too much to solidify some of the losses, because it still is substantially less valued than it was not so long ago.
Are they doing a service to the shareholders by doing this transaction with a 10 times oversubscription?
It makes a headline, doesn't it? You get the momentum, then you get the pop. You know how this works, Tom.
Exactly.
That's
but
the
it's on
ideal
steroids
scenario.
in the modern IPO game.
I understand.
Are they a SPAC?
Not quite. Stunning pictures out of Hawaii. Kilauea volcano erupting for the third time this year. The eruption started on Sunday after a 2-month pause. The lava, here's the good news, a safe distance from people and structures, according to the Hawaiian Volcano Observatory. But Tom, these pictures, the imagery this morning, stunning, absolutely stunning.
I've had the immense privilege of being very close to this by the ocean edge, and it is jaw-dropping. I've never seen that much lava flow. It looks like the season ending of, I think, X-Files.
It looks like a different planet.
5. It looks like a different planet. But the answer to me is, how is this like Mount St. Helens, which shattered our modern perceptions? And the pros here have a volcanic explosivity index, and Kilauea is not like Mount St. Helens, say the pros.
Yeah, this isn't going to necessarily be spewing. It hasn't been built up. Have you ever looked at the physics of underwater volcanoes and how they're so much more dangerous than actually above water volcanoes? I was actually looking at this yesterday, that it sucks in all the water and then it throws it out, and it's tidal waves and all sorts of things. It's just fascinating. I love this.
That's how you spend your afternoons. It's good to know.
Well, it was really interesting. It was a cool article.
Sure. This message just came in from a Bloomberg subscriber. This just for you, Tom. I'm feeling kind. Tom, spot on. Small float, sticky anchor holders. Okay.
Thank you.
On the latest IPOs.
Contrived is the only word I've got. It's so far from the spirit of what IPOs are going to be. They should raise the amount, bring in more money responsibly, and find where that proper subscription is. Besides your foolishness, that was a hell of a rubber chicken lunch. 10 times oversubscribed. Lots of good merch there from ARM.
ARM is its own beast. We've mentioned this a million times over the last few weeks. Anyway, let's move on.
12 months out. Right now, we're going to move on to, I'm thrilled with the research note. Megan Graber joins us right now. Excuse me, I'm gasping. I'm so anxious to get to this global co-head of debt capital markets at Barclays. Megan, thank you for featuring supply in your research note. Somebody said to me, rates are going to go up. They're not going to provide supply. I said, baloney. What are CFOs and CEOs doing right now? Everybody's issuing, aren't they?
They are. I mean, I talk about tidal waves. I think it's fair to say that our summer is officially in the rear view mirror, and investment grade markets in particular. We've seen just shy of 70 billion of supply in a matter of 4 days, which, to put that into context, is more than we saw in the entirety of the month of August. And a lot of that is really driven by treasurers, CFOs trying to front run what continues to be a data-dependent market and trying to get ahead of the central bank meeting on the 20th.
Within your pros sitting on the desk, what is the maturity tip point of that supply debate? Is it the belly of the curve? Is it farther out? Is it in wicked close? Where's that maturity point you study closest?
Yeah, so I mean, it's a tale of two cities in terms of where the bid is gravitating, which is definitively searching for duration in the long end of the curve. I think from a borrower vantage point, those that are electing to move forward, the supply is arguably going to be heavily concentrated in short dated maturities as issuers look to avoid locking in higher rates with the hiking cycle likely nearing the end here. So it's proven to be true out of the gates. I think we saw only about 13% of last week's record volumes, 15 years and longer. I think that's a thematic that's going to hold true through the entirety of the month.
The narrative last week was that issuance was going gangbusters and was going at the fastest pace. Some people were tracking since 2010. You put a different tilt on it, saying that, yeah, it might have been front-loaded. There were a couple of strong days, and after that, there's not going to be anything. And you're seeing a really slow September relative to history. Can you put into perspective the nature of the issuers coming to market, why they're coming to market now at a time of higher rates?
Mm-hmm. Yeah, I mean, as you say, it's been a misleading start to the month. And I do think we're likely to disappoint historic September averages. I mean, September tends to be the largest month of the year. I think 2023 is going to prove to be the exception to that, with the street by and large calling for the second lightest September going back all the way to 2015. Because I think there are borrowers who are all in yield focused here or taking a view that the scales are really tipped to waiting. The reasons for that are somewhat multifaceted. Some of this is this notable front loading that we saw in the first quarter of the year. There's also very limited event-related financings that are fueling sort of forced issuance into this fall window. So that would be typical of most Septembers. We have an anemic amount of M&A volumes that are likely to look in this side of the fourth quarter. And there's just overarching patience in the face of recent rate moves. Issuers have manageable redemptions. They've got diversified funding avenues. So if you think about the functionality of primary markets across currencies, the euro market is open, the yen market is open, the sterling market is open. So issuers are not beholden to a singular market or to a singular currency to manage their financing needs. So it's containing the size that we're seeing. Somebody like a Nestle is a good example of that. High quality borrower, well loved by the market, did $1.5 billion deal in dollars last week, and they followed suit this week with a deal in sterling. So there's an ability, I think, to appeal to multiple funding avenues to solve for size, and that's keeping volumes at bay.
We're talking about top-rated companies. We're not talking about lower-rated, higher debt level types of companies that have less reliable types of cash flow. From your vantage point, what is a sweat factor in CFOs' offices for some of these more speculative companies that aren't as profitable, that aren't maybe getting the same kind of access to markets?
Yeah, I mean, balance sheets are still in a very good spot. So in fact, the fallen angel volumes that we've seen this year have been a fraction of expectations. So even as we look to the high triple Bs that have emerged this week, it's requiring some incremental marketing. So the majority of deals that moved yesterday that had less frequent issuance into the dollar market and or were cuspier triple Bs did marketing to get investors up to speed prior to coming to market. But I think there's a comfortability with the fact that rising star volumes have been fivefold what we've seen in terms of fallen angels. So there's an underpinning from a just fundamental balance sheet perspective that's insulating investment grade.
Megan, after the Apple Roadshow today, after they announce earnings, whatever it is, the end of October, I mean, Tim Cook picks up the phone and dials 1-800-MEGAN. Are we going to see another Apple mega deal? I mean, aren't they just addicted to the issuance of bonds to buy back shares?
I'm sure investors would love that. I don't think I can speak to specific issuance. I think the key question we keep fielding is whether or not we're going to see any major reversals in terms of investment themes for names like an Apple or high quality tech companies that have dominated 2023. I think the short answer is not in the foreseeable future. And in large part, that's because the yield story is dominating everything. And the marginal buyer of investment grade credit, irrespective of where they sit on the globe, are compelled by those underlying yields.
Very quickly here, do you see spreads breaking? I mean, the huge surprise here for Bramo has been the idea that spreads have stayed in tight. Do you see any giveaway there?
You know, credit spread volatility is at close to a 2-year low. I think the IG corporate index at 119, it's still within spitting distance of year-to-date tights, but the consensus view is that risk assets are very fully valued here, and frankly, just not sufficiently wide enough as we approach the end of the cycle. But it's hard to be overly bearish over the near term, given the amount of cash that continues to be compelled by the carry opportunities afforded by credit.
Megan, thank you for the update. Megan Graper there
Bonjet
of Barclays. Luca Maestri is the guy over at Apple. Just the CFO is just unbelievable when it comes to supply and issuance and timing.
Why wouldn't they? They do another gajillion, 8 tranches. One's a 50-year tranche. They don't go Austria.
Not quite.
They could.
Hey, the chart of high yield spreads, Tom, is just hilarious. 370 now, near the tights of the year.
I mean, Bramo, this is the oddest market, and that was great. That was a window for equity people. That was a real window into bond chat, wasn't it? Major bond chat with Megan.
You know, people look at this and they say, how can I get scared about stocks if bonds are showing no fear also?
Well,
and you look at the fundamentals.
If we've got the time here, I'm still going to say one of the essays of the last 12 months is Lawrence McDonald. I believe I saw it in Zero Hedge, but off his website as
Larry's
well.
great.
Just the wall of money that's out there.
From Bear Traps.
Is incalculable.
We'll get Larry back on soon. He's great. If you're just tuning in, welcome to the programme. The S&P 500 negative here by 0.25% in the next hour. About 50 minutes from now, we'll catch up with Kathy Bostjancic of Nationwide. And then we'll be catching up with Bill Dudley, the former New York Fed president and Bloomberg opinion columnist, Tom. We'll be doing that shortly. That's one to watch.
James Dimon channeling Dr. Dudley here on Capital.
What did James have to say?
Today. James got upset at the Barclays Summit. He listened to Megan's bond chat, and then Jamie, started in on humility is in order, that government officials are getting a little boisterous in how they're treating said banks.
Did we learn the right lessons from some of the banking failures earlier this spring?
Yeah, he went right to it.
That's
and I think that's where Dudley is as well, as, It's so easy to go after people building mega skyscrapers on Park Avenue. I mean, there's no downside.
Have you seen the traffic on Park Avenue because of that mega skyscraper?
Yeah, it's great. Like every
Mr. James
boxed around it, everything's down to half a lane.
Being restricted to, maybe a quarter of a lane.
Yeah, quarter
at
of
times.
a lane.
Okay, we'll have that conversation. This one too. Can we talk about lags, long and variable? Jay Pulosky of TPW yesterday called it the lag reaper. The lagged reaper's not coming. He said. Bill Dudley wrote in the last couple of months that maybe we've seen the impact of 5.5% interest rates. We've seen the bulk of the tightening, Tom, and that's already come through the economy, come through markets.
I go to Dominic Constam, 8 months ago, 9 months ago, we're super restrictive with all these other global events impinging on what Jay Powell can do.
New York Fed President, the former New York Fed President, Bill Dudley, is coming up next.
would love to know what they really want to accomplish. Did they actually learn the right lessons from Silicon Valley Bank and First Republic? Like, you know, I think they have enough authority to tell banks you could take this much interest rate exposure and not that. And that would have solved some of these problems right there. So it was never a capital problem. And so I'm like, you know, what does they want?
The voice of Jamie Dimon, the JP Morgan CEO, speaking at a Barclays conference in New York, slamming a US proposal from regulators that would require big banks to increase capital levels. Bill Dudley, the former New York Fed president and Bloomberg opinion columnist, agreeing with Jamie Dimon. I'm no apologist for big banks. Regulators were right to impose much higher capital requirements after 2008. Yet there's a point of diminishing returns. Tom, capital is crucial, but more capital isn't the right solution for every problem. The words there of Bill Dudley.
Here's a lesson. Jean-Charles Rocher of Toulouse is the expert on this worldwide, and a major shout out to the Nobel laureate Michael Spence, who was definitive on this, tilting towards what you read there of Bill Dudley in about 2010. Swiss Bank Corp was taken out by an upstart Credit Suisse. They're both gone from Fortress Switzerland, which always had high capital requirements. I'm going to opine. Dimon's correct. Enough is enough. Joining us now, Dr. Dudley. He writes for Bloomberg Opinion. Of course, all of his work at the New York Fed in definitive market economics with Ed McKelvey years ago at Goldman Sachs. Bill Dudley, thank you for this important essay. On the calculus of diminishing returns, how efficacious is a lift in capital requirements of our big fancy banks?
I think the question is, what problem are you trying to solve? Was the problem that we saw in the spring lack of capital among the big money center banks, or is it a problem with supervision, problem with bad accounting, problem with bank management? I think the problem is not that the big banks didn't have enough capital. If you remember, money was running towards the big banks during the turmoil that we saw in March, not away from the big banks. And none of the big banks got into any great difficulty in the United States. The problem with raising capital requirements over and over again is you're making U.S. banks less competitive, and that's going to push activity out into the unregulated non-banking sector. The question that creates is, are you actually making the financial system safer, or are you actually making it more unstable?
Should we raise the capital requirements of entrepreneurial upstart banks with a strategic gimmick to build growth?
Well, I think we certainly want to be very close, pay close attention to those banks that are using novel business models. And I think as the Fed itself admitted that we need better supervision. The problems of Silicon Valley Bank were identified in a relatively timely way, but then the supervisors didn't force the banks to make the changes necessary to prevent its demise. So I think that better supervision, more diverse stress testing, better rules on interest rate risk taking could go a long way to avoid these kind of problems. I'm not sure raising the capital requirements of the biggest money center banks by 15 to 20% is the answer here.
Bill, you talk about in your column the importance to recognize non-banking institutions as competitors, and that you really just increase their share by restricting the lending capacity of big banks. Should regulators be basically going down to the lowest common denominator of less regulated non-banks, or should they put more of an eye toward non-banks and regulate more closely some of those activities?
I think they should be focusing on what's the best solution for the resiliency of the overall financial system, banks and non-banks. Obviously, if you increase requirements a lot on banks, you're just going to have a bigger non-bank regime. And the question is, does that make you safer or does that make you more vulnerable? So I think there needs to be balance here. Also, I think that the real question here is what was the problem and what's the right solution to solve the problem? It's not clear that raising capital requirements on large money center banks solves the problems that we saw in March of this year.
Can we say that the banking crisis is over to the extent that it ever happened, and that going forward this is not going to be some sort of bigger financial risk that could torpedo the Goldilocks scenario, at least for the moment?
Well, you never know, but I think that so far the knock-on effects of what happened in March are pretty modest. And I think that's because it really was concentrated in a few banks, and it was all happening in plain sight. People knew exactly why these banks were getting into difficulty. They could see their interest rate risk exposure. They could see what's happening to their capital on a mark-to-market basis. So this is not like the great financial crisis where everything was happening in the shadows. People lost confidence in their counterparties. So I think so far, at least, it looks like this is a pretty modest knock-on effect to the real economy.
So if that's the case, and that isn't necessarily a headwind going forward, do you lean into this idea that maybe the Fed should be done and that we are looking at a scenario where they have the opportunity to just wait and take a look at the data on a longer and longer term basis to make any decisions?
I have no quarrel with the Fed waiting to get more information. I mean, they're pretty confident that monetary policy is at a restrictive level. If that's the case, it should slow the economy down. As the economy slows, we should have more slack in the labor market, and that should take away some of the upward pressure on wages and bring inflation down. I think the key question is, how restrictive is monetary policy today? It's possible that monetary policy is not quite as restrictive as the Fed thinks. And if they find that out over time, then they can obviously do more or keep rates higher for longer.
Bill, I want to finish there. You wrote about this earlier in the summer. I don't think it was picked up on nearly enough. I've been talking about it as much as I can. This quote from your column that read as follows, and I had the quote ready for you, Bill. There's considerable evidence that lags have shortened, meaning that the economy has already felt nearly all of the impact of the Fed's actions. Bill, talk to me about that evidence. Where do you see that evidence currently?
I think the most obvious piece of evidence is what's happening in the housing sector. The housing sector, obviously was hurt a lot by the backup in mortgage rates from 3% to 7%. But recently, the housing market looks like it's bombed out and isn't having any further weakness because of the rise in rates. The other thing that's important to note here is monetary policy works faster than it used to because the Fed uses forward guidance to guide the market, not where it is today, but where it's headed. So financial conditions, most of the tightening in financial conditions that we've seen over the last couple of years happened last year, not this year.
I remember, Bill, a conference that you and I did together with Mohammed Al-Arian in the summer of 2021. I think it was early summer, around June time. And you were both talking about how inflation may well be stickier than people think. And I remember you, Bill, threw out the number that maybe rates have to go to 5%. 5% back then sounded absurd. We're through 5. We're through 5. And we've gone right the way through 5. Bill, what are you thinking about now? Best case on where you think sufficiently restrictive might be?
I think that it's more likely that they hold rates here or maybe one more rate hike as opposed to go ever higher. I think where the market may be a little bit off base is to think that the Fed's going to ease a lot in 2024. I think the last mile in terms of getting inflation down, I think is going to turn out to be pretty difficult. And so I think that means that the Fed's going to keep rates higher for longer than people think. And I think that's one of the things that is feeding into the bond market and why bond yields have moved higher.
Bill Dudley, thank you, sir. Former New York Fed president and Bloomberg opinion columnist. Some fascinating insight there, Tom, on the regulatory backdrop around the banking story, but also on how far this Fed might have to go, and how high they might have to stay at these levels, how long they might have to stay there through next year.
Well, that's a monetary ballet, which gets, 98.285% of the discussion here as well. And you see it, with Lisa's wonderful patience and this Fed speaker and that Fed speaker and all that. There's a whole other part of the Fed. And what Diamond's screaming about, and he's got a lot of company on this, is this conflation in people's mind of regulation, like what are you going to do with the big banks, versus supervision, which is go out there and look what they're doing. And this conflating of regulation and supervision is the heart of the matter. Again, Rocher at Toulouse owns the high ground on this, and we failed. And Diamond's 100% correct.
Just to put a bow on that, a supervisory failure, not a regulatory failure.
Yes, thank you. Excuse me.
No, you took us there. I just wanted to get to the headline. Tom, great guest for you to speak to all of this about. Bob Michael at JP Morgan. You can ask him everything about Jamie's thoughts in the last 24 hours.
And he wrote the script for Diamond. We know that. But, Bob's not going to talk about that. I mean, is Salah still at Liverpool?
He is, yeah. He wasn't
at
sold.
least this week.
Yeah, the transfer
Maybe
window
Bob will talk about that.
Closed in Saudi. So Liverpool keep their man. That's the good news, I guess. He might have something to say on Everton.
Is the Merseyside derby, is that Everton and Liverpool?
It is, yeah.
Oh, okay.
The blue and red sides.
How many miles apart are they roughly?
Pretty close, same city.
Okay. I'm learning.
You are. Every day. Every day. But Michael, JP Morgan
I got my Everton bow tie on.
Joins us up next. Bullish bonds. Is that what that was for?
Yeah, that's
Everton?
what it's for. We got a chairman of the board who's all Everton, so I'm all Everton.
You keep referring to this. Is Mark Carney an Everton fan? I didn't know this.
Yeah, he called me up the other day.
Since when?
He's like, huge. I don't know. He's been an Everton fan since whenever.
Where does that come from?
I don't know. I said, can't you go with the Tots? And he said, hell no.
Everton. Oh. I didn't know that.
Yeah.
King was Aston
Know
Villa.
your chairman. Rule 1.
Yeah, I mean, that's some good advice, TK. Some good career advice.
How about that UNC football season? It's just great.
I'll get in touch. I'll try and work that out. From New York City this morning, good morning to you all. Equities on the S&P lower here by 1/3%. This is Bloomberg.
I do think that the recession risk remain out there.
There does seem to be a lack of upside catalyst.
We've got a long way to go before we can sound the all clear on inflation fight.
We need to be very careful about reading too much into a single data point.
I think for the most part, it's going to be wait and see, at least for this week, ahead of FOMC next week.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. We begin the week with Apple. In this hour, complete curbside coverage, Bloomberg Technology in Cooper. Ed Ludlow will be there, I believe.
This promo's going well. Keep going.
You know, it's great. I mean, Ed Ludlow's going to join us in this hour about Apple foolishness. Let's clear that out of the way before we move to serious stuff. It's a product launch.
It is. The
That's
iPhone
all
15.
it is.
Apple captures just about every big story out there right now. I think from my perspective, the tension between the US and China, the competition you're getting from foreign brands, Huawei, and cost pressure here domestically in the United States. If the consumer is weaker, can it cough up higher average selling prices over at Apple? TK, that's going to be the test for the consumer later on this quarter.
Are we going to learn about those distractions today? I don't think so. They're going to stay on script.
No, this is
smiley,
the marketing,
smiley.
the happy stuff, smiles and all of that good stuff. But what we want to know is, are you moving more to India? Are you moving away from China? Are you in China for China? And how much can you sell to that country? And is that Huawei, what was it, Mate 60 Pro Plus and all of that good stuff? Does it have the capacity to compete with you at scale in the world's second largest economy?
The Bramo fam is all Huawei. They're looking at it carefully. I mean, Lisa, the foolishness of this, the reality is it involves gajillions of dollars. It was a $3 trillion company.
Well, also, isn't the whole story of this year in the stock market kind of a big product launch with ChatGPT and artificial intelligence?
Yeah,
I mean, if we're looking at this idea of what's been driving the momentum in U.S. equities, it has been on the heels of products in the tech world. So that's why this is actually more important potentially in signaling not only, you know, the bottom line for Apple, but going forward, artificial intelligence, what's the future of computers? Are we all just going to be wearing goggles and sort of dancing around?
I mean, what we do is we have the different conversations here on Bloomberg Surveillance. We're going to do bonds in this half hour. If you're part of Global Wall Street, Bob Michael will join us here in a moment. But, John, I got to go to the tag team equity moment we had this morning. Greg Bowdle, bear, lifting, and Stuart Kaiser, enthusiastic, reaffirming enthusiasm out into 2024.
So let's talk about the bear. It goes from 3,400 to 4,150 on the S&P. Was the biggest bear on Wall Street, now just slightly bearish on the S&P. Well, Stuart Kaiser of Citi had to say, good news is good news.
Thank you.
He's very, very clear about that this rally has been built on good news, better news in America. And if things start to sour, then his view on the equity market will start to sour as well.
I think our conversations here are so important. Let's do a speed data check. John, the real yield, 1.94%.
Bonds look like this, Tom. 10-year, 428.21. Yields just about unchanged. We've got a bond market bull around the table with us, so we'll get to him in just a moment. In the equity market, equity futures, TK, just a little bit lower, negative here by 0.3%.
Bob Michael joins us right now. He is with J.P. Morgan Asset Management, global head of, equities, bonds, currencies, commodities, I don't know, everything else.
Let's stick with bonds for now.
Let's stick with bonds for right now. Do you buy across the curve right now? Because simplistically, it is going to be price up, yield down.
So the product launch of the year isn't ChatGPT, it's the bond market. It's the repricing of bonds just across the system. And we are seeing money come in. And even though there's a soft landing cap, there's concerns about inflation, there's concerns that the Fed could keep rising rates indefinitely, actually, the highs from October, almost a year ago, have held pretty well in the long end of the curve, 5, 10s, and 30s. So it's not just me saying take advantage of the repricing of the bond market. We have clients left, right, and center, domestically, foreign countries, retail platforms, institutional platforms, looking at where to get into this bond market, and they are putting money to work.
Are they chasing income? Are they chasing total return? Worried about a slowdown, taking on duration? How has the nature of that money shifted in the last few months?
Yes, exactly.
All of the above.
They're doing all of those things, and it depends where they're coming from. Wealth management platforms are looking at municipal bonds, they're looking at corporate debt, they're looking at treasury debt, and they're putting ladders of maturities in place. So they're buying bonds out to 10 years with maturities every 6 to 9 months, something like that. So they just want to get into the bond market before these yields disappear. Institutions, whether they're insurance companies or their pension funds, they're looking at their liabilities having deflated, and they're looking to put money into the long end of the market, and you have a whole host of others that are looking for total return. So you can do pretty much everything in the bond market. We haven't seen this since 2006, 2007.
There's only one sentence I heard in all of that: before these yields disappear. These yields aren't disappearing. They've been quite stubbornly high through summer. That's been unexpected for you, I know, Bob, relative to your call. What do you think's behind that?
Well, I think there are a couple of things. This reminds me a lot of the second half of 2021 when yields were ridiculously low. The Fed was talking about transitory. The market bought it. We are looking at inflation going up and saying, if they leave rates where they are, inflation's going to continue to accelerate. Now we're looking at rates very high. We're looking at very high real yields. We're looking at inflation coming down a lot. And the Fed is talking about leaving rates where they are indefinitely, higher for longer. I want to see the summary of economic projections. Is it tomorrow?
Next Wednesday.
Next Wednesday.
Yeah.
And the infamous dot plot. They've got 100 basis points of rate cuts priced in for next year from the last dot plot. And they've also got inflation coming down. So they're acknowledging that if they keep rates where they are and inflation comes down, then policy rates become progressively tighter and the economy may not be able to withstand that. I think what's keeping rates where they are is the market is believing the Fed rhetoric and not believing that they may have to cut rates.
Your previous call at the start of summer was cuts by September. Clearly they won't be cutting a week tomorrow. I want to understand from your perspective what's going to deliver those cuts. And when you're thinking about yields we haven't seen since 06, 07, some people might be listening this morning thinking, well, bad things happened after that. Do bad things happen now? And of course, I'm not saying on the same scale to the same magnitude of what we saw in 08, but are you anticipating bad things?
So at the start of this year, we thought something like recession by the end of the year. Then we had the regional banking crisis. And we thought, well, that's going to bring recession forward a few months, so they should be cutting by September. And I think what we looked at and probably got wrong was the backstop that the central banks, the Fed, put in place, the bank term funding program. And we likened it more to a Bear Stearns bailout. It probably was more like TARP. It just created more liquidity, backstopped the entire banking system. These things are still hiding in plain sight. The regional banking crisis hasn't gone away. I wish you had asked Bill Dudley when he was patting himself on the back in the Fed about, no, this is all in the rearview mirror. Really? Look at the bank term funding program. It's quietly increased in size the last 9 consecutive weeks. It's at $108 billion. So the regional banks are not working down their borrowing, and that's coming in at 5.5%. That's telling us that they still need cash available to meet depositor outflows. So I think there are plenty of things out there that are slowing down. Growth and inflationary pressures are coming down. For the Fed to pause, we've said for a long time, you need disinflation and inflation to come down to levels they're comfortable with. I think tomorrow we're going to get the third consecutive core CPI print at 0.2. That's enough for them to pause with a lot of the other disinflation that we're seeing. I think this time for them to cut rates, they're going to have to see unemployment go up. So it's possible that they may actually tip the economy into recession first before they start cutting rates, which would be something new for them. It would be positively ECB-like.
Well, okay, but going forward then, how does this cohere with a 3% yield curve across the board, a flat yield curve in the near future, by the end of this year, or even by mid-year next year? If you have a Fed that's being patient, not willing to cut, and you have economic data that's coming in hotter than expected.
Well, this is the Fed that promised us transitory and then within a couple months changed their mind and started hiking rates. We think we're going to see the same thing this time. They're going to tell us that they're going to keep rates higher for longer until inflation is at their target. But the magnitude of the slowdown we're seeing across the board tells us that we'll probably still be hitting recession around year end, so they'll be cutting rates by then. So I'm still incredibly comfortable that we'll see 3% across the curve.
Do you think high for longer is just a bad call, or do you think they're just misleading us, that that's what they want to signal currently?
I think it's what they have to signal, because they were already wrong once on inflation with the promise of transitory. They can't be wrong again. They're telling us that they're prioritizing inflation over growth, and that means, like the ECB, you're willing to make the economy a casualty.
I guess what I'm getting at is, do you believe them? Do you believe they're prioritizing inflation over growth? Or at the first sign of weakness, do you think they back away?
Well, I think the consumer is incredibly stretched right now. When you look at the Beige Book, you're seeing signs of that all over the place. They're talking about the last bit of pent-up spending on leisure travel. They're talking about consumers that are trying to maintain their level of spending since their excess savings have run out by putting stuff on borrowing, which is a very high way to finance yourself. So things are going to slow down pretty quickly. We look at news coming out of Truist where they're starting to address cost pressures by laying people off. So the labor market doesn't look as robust as that mid-threes unemployment rate. We think that starts to go up, and it will force the Fed's hand.
Let's dig into that in about 5 minutes' time. Bob Michael of JP Morgan Asset Management is going to be sticking with us, TK, for a second segment to get into the latest data in America, into CPI tomorrow morning.
Well, it's the data flow that we're seeing, the data dependency that we're seeing. I got like 8 questions for Bob Michael. It's good
Well,
that he's
save them
going
up,
to stay around
Tom.
for the half hour, but you know, to me, it's just simple. We're completely data dependent starting tomorrow.
If you're just tuning in, welcome to the programme. Equity futures on the S&P negative here by 0.3%. Coming up shortly, a second round with Bob Michael of JP Morgan Asset Management. Tom's going to deploy at least 4 of those 8 questions, Tom.
Yeah, Jamie Dimon gave them to me. He's so fired up. He said, ask Bob this.
Bob's got time at a commercial break to run now. You're going to squeeze a Liverpool one in there as well?
We got to. I mean, I'm fascinated. Bring me up to date. I adore Salah. He goes mental. He goes right for the net. It's just a joy to watch him play. He's with Liverpool, but there's still this option he could go to Saudi Arabia.
Well, that transfer window is closed now, Bob. So
but
that
they'll
threat
reopen
for now
it for
has
$1
gone away.
gajillion.
For now, do you think that threat comes back a little bit later this year, next year?
I think it does. And I think the lure of Saudi could be appealing to him and to Liverpool. But they've got a deep team now. They've got a lot of scorers. They look very lively up front. They're not dependent on one player anymore.
Your opinion on Nunes has changed overnight, seemingly. He's like the man now. You're comfortable with him leading the attack?
They've got more than just him.
Okay. 8:30 Eastern Time, Kathy Bosch-Jancis of Nationwide Mutual Insurance will be joining us. So that conversation is 17 minutes away. We'll have another round of conversation with Bob Michael of JP Morgan Asset Management in about 5 minutes' time. Just to set up your trading day, equity futures here are negative by 0.3% on the S&P 500. Going into that launch of the iPhone 15 a little bit later on this afternoon. Apple in the crosshairs of US-China tension, driving a stock lower last week by about 6%. The weight on Tim Cook's shoulders going into this launch. Trying to sell it here, TK, for Ed Ludlow and Caroline Hyde. The weight on his shoulders to make this iPhone 15 a success has never been bigger.
Fanboys with us this hour, right? Fanboys with us?
Is Ed fanboy?
He's fanboy.
Ed
Wicked
Ludlow's
fanboy.
coming up in about 30 minutes' time from New York. This is Bloomberg.
We've always had a recession in 2024, we're moving perhaps away from a recession in the early part to more the mid part of the year. But, if the recession is still very much in the cards, and if that were to play out, I think you should start seeing a moderation in yields, or the sell-off in yields we've seen at the back end.
So Badra Ajapa, the head of US rate strategy at SocGen, with yields near 4.30 on a 10-year, near 5% on a 2-year, and the threat they go higher off the back of this move in the commodity market. Brent crude, new high for the year, $90 and about 60 cents, $91.50 is the new high for the year. Where we are right now is 91.45 and up by 0.9%. This headline right here, thank you, Grant Smith, over in London, for writing up this story. Global oil markets face a supply shortfall of more than 3 million barrels a day next quarter, potentially the biggest deficit in more than a decade as Saudi Arabia extends production cuts. Just a little bit of a push higher off the back of that headline, Tom, moments ago.
Francisco Blanche giving us the microeconomic foundations of oil. And he said, we're here, we're where I want to be. And he set out the microeconomic case, supply and demand, to get to 100.
Headline inflation tomorrow will speak to this story. Higher gas prices. Core won't. The issue that I think we've all got, the question we're asking, Tom, is how much attention the Fed pays to this a week tomorrow.
They're going to look at I think they're going to look at the aggregate data. David Rosenberg's been a great student of this, and that there's this. But, Lisa, I think, has been on this. The answer is oil, and a gallon of gas is a political instrument in America.
And at a certain point, as oil prices go higher, it influences prices in other areas. And that's sort of the issue. And it really gives people the appearance of inflation. So it raises this question going forward. Right. Does the Fed use that more than they think?
To me, it's behavior. I mean, if I'm where I'm living and I never go below 59th Street, I mean, that's an example.
Except every day when you come to work. But yeah, sure.
Okay, half a block. But I'm not, I've been down to Soho in 14 years. But the bottom line is, the bottom line is, if I'm at the Jackson Hole Economic Conference, it's nothing to get in a Suburban and drive to the $1 Million Cowboy Bar, which is like a gazillion miles away.
Speaking about your own life.
And that's the way the rest of America is.
I hear you. They drive a lot.
They travel a lot. That's all there is to it.
The gas price means a great deal. It shapes their views on where inflation is and where it will be as well. That's the difference, Tom. It shapes expectations too. You see that in you, Mitch, quite a lot. Yeah. The correlation between expectations and where gas is right now.
Out to a new high on Brent, 91.50 printed moments ago. We continue with Bob Michael of JP Morgan Asset Management. What I was thinking about, Bob, and this goes back to the acclaimed, toughest resume, toughest admit in banking, the analyst program of JP Morgan, is the real yield we're at right now began within the data that we have in the modern age in 2003. And that a huge body of our audience has never lived this rate structure and all of the follow-on to it. What's your counsel to someone, say, under 37, 36, 38 years old, of how to address a whole new world after all?
Well, I think you have to understand that markets go through cycles. The cycles can be very long. Probably the last 15, 20 years weren't normal. They were the distorted years. They were the years that the baby boomers wrecked by over-leveraging the property market, crashing it, and then taking a decade to repair. We think we're going back to an environment that is more normal, where there is a demand for capital, there's a use for capital, it's productive, and there will be a cost for capital again. But you don't get there all at once. I think a 525 basis point rate hike is a shock to the system. It will slow things down. We think the next move coming out of the Fed will be to cut rates. We think you go back to 2.5% to 3%. Yeah, the next tightening cycle, maybe they have to go to 6%. And you start putting in place the mirror image of what we saw in the late 80s and the 90s with falling rates. You may now see rising rates. So we have to get them used to inflation can be real, and markets have to price that in, and central banks don't always bail you out.
There's a lack of clarity in terms of how central banks really understand inflation. They say they look at core, and then headline starts to move sentiment, and then they start going after that. How much do higher oil prices, materially higher oil prices, play into the risk that the Fed remains higher for longer?
There used to be a wonderful chart everyone would dust off every time oil prices went up, that oil shocks create recessions. And it had it was another one of these 100% perfect predictors. And we're getting another oil shock at exactly the wrong time. After credit conditions have tightened dramatically, after the cost of funding businesses and households has gone up a multiple, we're talking about business and households having to spend on energy at a time when their real incomes are much lower. So they're going to have to cut back somewhere else. I think it actually is another one of these things that's a warning that recession may be more present than the market thinks.
When does it count as an oil shock? Because we are seeing prices normalize. They're not necessarily going to the highest that we've seen of this particular cycle, but they are the highest going back to last year. What's your tipping point for when it is prohibitive of growth?
Well, you have to look at the cost of production and the cost of getting a barrel out of the ground and where we are now. And what we're seeing is that OPEC is telling us maybe demand isn't quite there, but they're not willing to live with much lower oil prices. They want the volume to replace the demand. It's not there, so they're going to make it back with pricing, and they're going to push prices up. We'll see how high it goes. But for me, it's another sort of yellow warning flag out there. I don't think it helps the economy at all. I think it's another thing that squeezes an already stretched consumer.
Bracket the inflation-adjusted yield right now. At what level up above 2% does it really begin to impinge on the system?
I think coming off of several years of infinite free money, we're seeing it bite right now. We're seeing it in the housing market. We're seeing it in the cost of funding credit card purchases. You look at businesses, they front-end loaded a lot of their borrowing, but now they're going back and they're addressing other cost pressures. And they're not doing it by just borrowing more and absorbing the cost pressures. They're actually starting to cut costs. So I think it is now starting to bite. I don't think long and variable lags to monetary policy, that law has been repealed. I think it still takes time, and we're still in the early stages of it. I think the next 12 months are going to be pretty painful.
What would you have to see to make you change your view?
I'd have to see a legitimate reacceleration of core inflation, and that would tell me that we're in a different regime. Maybe the XYZ generation is large enough, they're earning enough, they're spending enough, that it is driving an economy that is going to a new high, and central banks do have to come in and really dial down the desire of the consumer to spend. But right now, we're not seeing that.
Are you Googling the XYZ generation? Is that what you just did?
Yeah.
What are you up to?
What is the XYZ generation? I've never heard of it.
XYZ?
It's the X, the Y one, and the Z one.
Yeah,
It's
no?
Gen X,
Okay.
Gen Y.
Like combined together.
Gen Z.
So think the 91 births.
can't keep up.
The 91 births are now the largest population cohort, and they're 32 years old. So that's the one. And if we go back to the financial crisis, they were 17 years old, and we wondered, how will we get through this before they replace the baby boomer as the dominant consumer? Now we're there. That's where we could be wrong. I don't think so.
They're the crew that, after the second REM album, they were never the same.
Thanks, Tom. Bob, thank you. Bob Michael,
pleasure.
JP Morgan. I've got the official statement from Valerian on the Jets if you want it.
Oh, please.
So diplomatic. Just writes in. The Jets showed inspiring spirit and determination, overcoming an early setback that would have derailed most other teams. We will remember this incredible win for a long time.
Oh, my God.
That's so official, isn't it? From Mohammed. Is that him
Well, he's
auditioning
at the 50-yard line.
Does that sound like a man who owns the club? That sounds like a man who owns the club, doesn't it?
Yeah,
Might be the future chairman of the Jets. Is that what's next for Mohammed?
Yeah.
Potentially.
He wouldn't give us tickets, but hey,
That would be nice, though, if he did give us tickets.
His seats are unbelievable. They're like
I've seen
4
them.
rows up,
It's ridiculous.
50-yard line. It's like he's like a rock
hardly
star.
ever there to
He
sit.
can see just above
I know.
Aaron Healy on the sidelines.
I know. Bob, thank you. It's good to see you. Coming up on the Open, Chris Harvey, Wells Fargo, Cameron Dawson, New Edge, Vichy Rapporteur of MorganStanley, and what we call in Ed Ludlow, Fanboy.
Fanboy
from
there.
Cupertino,
He's got
California.
a black turtleneck on.
The iPhone 15 in New York. This is Bloomberg.
Waddle at Bloomberg Surveillance. How do you listen to what we do? We're going to pause here in the modern digital world and say, what do you do after the show? And thank you for watching us on Bloomberg Radio and Bloomberg Television. The first thing you do is read the Bramo letter. It's the Bloomberg Surveillance newsletter. Lisa, tell us about this. The people, Ray YouTube and the others that keep track of this say this newsletter is successful.
Well, it's basically that if you don't catch all the interviews, pulling together snippets. And I will say that people say such fascinating things, and it can get lost, but they speak to each other, which is one really cool thing that I enjoy. That people kind of weave together the day's narrative together.
Yeah, Lisa and Ed Duffner are going to team of like 7 people, 3 interns putting this tome together. It goes on pages and pages. And of course, on Bloomberg Digital on YouTube, look for our conversations. Stuart Kaiser on the market. Bob Michael, they're just brilliant on how the new bond market is the old bond market. With that in mind, in charge of all of our economic coverage, international economics and policy correspondent Michael McKee joins us. The next 48 hours, CPI is a big deal. I get it, but I got to dovetail it with the day later retail sales. Piece the two together. Inflation report, consumer report.
Well, the consumer report obviously is influenced by the inflation numbers because then
it's
you have
nominal.
an artificial. Yeah, it's nominal numbers. It's artificially increased. So it's more the trend that people want to see. And when I say people, I'm pretty much talking about the Fed and then anybody on a trading desk who's trading the Fed. And at this point, they're expecting a reasonably good month for the month of August with the retail sales up a little bit, but not going forward. That's the question. What happens as we get into September, October, November? And a certain amount of that will be determined by CPI prices, particularly, you've been talking about it all morning, oil prices, the fact that they're going up and they'll push, at some point, gasoline prices up significantly. So the interesting thing about that is we can wring our hands all we want, but there's nothing much that anybody can do about it.
Well, but it would be great to get your sense, to build on that, of how the Fed views oil prices, energy prices as an input, given the fact that it is inflationary on a headline figure, but does remove money from the discretionary pot of spending.
They could raise rates all they want. It's not going to change the price of oil. That's the problem for them. So they have to kind of look through it. They tried in the 1970s to be accommodating lower prices, lower interest rates in order to give people more spending power as gasoline prices went up, and we saw how that worked. So they're not going to do that again. I guess part of the question now is going to be when we get to CPI tomorrow, how much does headline matter to people versus core? Because the core is not expected to have gone up any faster, 0.2%, and on a year-over-year basis fall to 4.3%, which would be considered good news. And the Fed's going to be looking more closely at core. But after a while, if energy prices keep going up, it will feed into the core as well.
How many is the new data dependency when it comes to the number of months you have to see before Fed officials start to care?
I would hesitate to put a number on it. They use the old pornography Supreme Court defense. They can't describe it, but they know it when they see it. A couple of months is of increases would put more pressure on them to raise rates again. It's going to be very interesting this month to see what the SEP, the Summary of Economic Projections, and the dot plot show. Do they still keep that last rate increase in there to keep the markets from thinking that they are done?
Michael McKee, with an eventful 48 hours coming up. We'll look forward to that. And of course, he'll go beneath the headline data tomorrow at 8:30 on CPI, core, this, uncore, supercore, whatever it is. I can't keep track. One who can keep track is Kathleen Bisjonczyk, chief economist at Nationwide Mutual Insurance. Let's begin there, Kathy. Jerome Powell talks about the Dallas Trim Mean. I'm partial to the nationwide Cleveland Inflation Index and the rest of it. Which inflation series do you follow to get a feel for what America's feeling from inflation?
Good morning, Tom. Happy to be with you. Well, I look at all of them, but I think, Mike's comment was quite noteworthy in that the headline, so with oil prices rising again and putting upward pressure on gasoline, the consumer for some period of time, may even also look through these higher energy prices and say, okay, this doesn't mean that inflation's picking up overall. But if it continues, that could lead through to inflation expectations. And again, that's still a worry for the Federal Reserve because inflation overall is still high. Less of a worry because we've seen some nice disinflation. And as you mentioned, the super core inflation, which is core services ex rents, that has started to roll over, especially the 3-month annualized. But the core, I mean, if you really want to boil it down simply, it's really the core CPI measures right now that matter the most. Right. Assuming we don't see oil go through, $100 per barrel.
It's a dual mandate Fed, and I get 3-month annualized forms of unemployment and jobs coming down nicely. Is the job market broken? Are we finally moving down to new levels of a lower non-farm payroll?
Well, far from broken. It's still a very strong labor market, but it seems to be cooling, and it does seem that the Fed's getting its way here. It's removing some of the demand, some of that froth, and yet, not crushing the economy. Time will tell how this plays out, but you even see the wage growth numbers, cooling. So I think the odds for soft landing have gone up. We ourselves are a bit more cautious, but we've trimmed the recession shortfall. We now think it's more of a mild instead of moderate. We have to be, reflective and respect the incoming data that inflation does seem to be moving, downward more quickly than we thought.
We were speaking with Claudia Sahm yesterday, formerly of the Fed and the Sahm rule, and she was talking about how we just don't know yet. We're holding our breaths, trying to understand whether the decline that we've seen in some of the employment momentum is just a softening or whether it's the beginning of something more protracted. How are you viewing this? How are you looking at this to understand which it is?
Well, I agree with Claudia. We definitely, need time. But the recent blip up in the unemployment measure was really because more people came into the labor force. The labor force participation rate, as you know, went up. And particularly when you look at what they define as the prime-aged workers, 25 to 54, we're back over the pre-COVID level. So that's a sign of a very strong labor market. You're pulling people in. The fact that the unemployment rate went up is just because job growth couldn't keep pace with that. It's still not a weak labor market. That said, the fact that the Fed's going to hold rates, we think, steady, and as other guests have talked about, as inflation comes down, the real Fed funds rate goes higher. That's where the restrictiveness comes into play. But I think at the same time, if you do get inflation coming down, it just takes some of the pressure. And in real terms, growth is higher because of that, right?
Kathy, there's also this lack of clarity around whether there's a structural shift in the labor market. We'd been talking about that a number of months ago about how, there just were fewer workers. And so you had to pay up in order to get anybody in the door. How does the UAW potential strike, the negotiations we've seen there, we've just heard from UPS yesterday on Bloomberg Television talking about how the increase in wages and the agreement that they came to is going to impede some of their profitability. But going forward, this is the norm for them. How does that shape your view about what we can expect, the stickiness of wages, regardless of how much the jobs fall, et cetera?
Yeah, a great point. And it is, that is the risk that we do get that stickiness still in wage growth and inflation, as talked about, maybe going from 9 to 3% on inflation was sort of the easy part because of year-over-year and energy prices, until recently coming down, but getting the core and especially service prices to moderate even further, and wages play a big role of that. So it's something we're watching very closely, and it's definitely, it plays into that whole profit margin squeeze. That's why we still have a recession. We do think that profit margins get squeezed, but it's just not going to be quite as large of a shortfall as we thought previously.
You explained beautifully the complexities of our labor picture. Are the dynamics, the plumbing of how we look at the labor economy, is it a similar study to what you would have done 10 years ago or 20 years ago? Or do you have to have a whole new outlook on labor dynamics in America because it's a new America?
Yeah, that is a great question. And yes, you do look at it differently now because the backdrop, we have the demographic change rate in America. We have the aging of our society and the baby boomers continuing to retire. That's playing into this whole labor shortage. Yes, we have a labor shortage because cyclical forces, but also secular, and that is not going to necessarily go away. The question is how that is really handled by corporate America. Can they continue to adjust? And what we don't know, the big question is what happens with AI, right? And AI generative, does that replace some of the shortage of workers? And is it already doing that? So it is a very different dynamic. We never saw job openings relative to, the demand for workers relative to the availability be this strong. So job openings relative to unemployment is still very high. And we've not seen that, historically.
Kathy, are you going to be watching the Apple launch, the event, the marketing event, as Tom says, at 1 p.m.? And basically, are some of these product launches macroeconomic tools to understand the future of just some of those instruments?
Well, I have to say that myself, but particularly my younger son, is really very excited about these new launches. So if we don't catch it live, he shows me how to find it on YouTube. So I'll watch it one way or the other. But it is really exciting. And I think certainly in general, innovation, creativity, these are important. And obviously Apple being one of the big performers up until recently, some of the issues with China. But in general, what we're seeing really like the top 10 stocks in the S&P have generated 80% of the gain of the index. That's pretty concentrated, right? And pretty impressive.
Kathy, thank you so much for the brief on the American economy. Kathleen Bostjancic with Nationwide. Kathy and I go back years, and I love talking to her because of the knowledge and the granularity underneath the headline data that we blather every day.
Well, I also love that her son also makes her watch the Apple launches and really get her excited about the products that she will then be encouraged to buy.
I would take it to the international claim, and this is, of course, the debate here of the new cord that goes into the new iPhone, is we have that effervescence, what Ned Phelps would call dynamism, and they don't, and that makes for the American difference. Interesting market, percent change on the Standard & Poor's 500, a negative 0.2%.
Coming up, we are going to take a look at what to expect from this particular event.
We're actually going to do it.
Well, look, you call him fanboy, which I'm guessing is completely abhorrent to him. But I will say, look, this is a big deal, not for Apple per se, but because it's such a big company in the S&P 500, in the NASDAQ, because it is such a big aspect of the U.S. economy at this point, and because of AI and generative intelligence.
My observation on this, and I've always tried to not be a fanboy, even though there's a zillion Apple things at home, is what's different now, and I didn't expect this, is Apple is cool with the kids. For years it was Android, only the old farts like you use Apple, and that's changed. And I did not expect that. It's not Huawei. Samsung's basic, I saw a chart the other day, it's shocking, the deterioration, but Apple's, because of the ecosystem, is cool.
Yeah.
I did not expect that.
Do you have cord wars at home? Like where people take each other's cords?
No, what we do is Dad buys more cords. So we have so many cords.
This is a real phenomenon.
The dogs chew on the cords and no one cares because there's another 5 cords to replace the one kennel fee.
The way you describe
kennel fee's the worst.
The way you describe your house, it's sort of 45.
Oh, you have no idea.
Just completely mismatched under the couch, and then you've got cords that are chewed up, lying everywhere. People yelling.
Yeah, Karen from Sydney knows this. We serve martinis at the front door. It's
I could guess
that bad. KB knows that. There's no question about it. Futures -9, Dow futures -24. Coming up, the most anticipated conversation of the day. Fanboy joins us from Cupertino. This is Bloomberg. Stay with us. Must watch, must listen.
It's hard to get away from tech. There is this structural growth story. So if we're in an economy that is slowing, albeit at a more gradual pace than we anticipated, then the structural growth stories are those that are going to outperform. The issue with tech is how far it's rallied this year. So I think the story going forwards in tech is going to be about being more selective
Greg Bottle, U.S. head of equity and derivative strategy at BNP Paribas, earlier today as he talked about why he is abandoning some of his bear call, but also in the dominance of tech ahead of this Apple event, the marketing event. Tom Keene alongside me, John Ferro off at his 9 a.m. property preparing for that. But really, right now, before we get to that, I want to just talk about oil, hit it quickly, because we are looking at $91.51 Brent after this announcement by OPEC that there's going to be a 3 million per day barrel per day shortfall in total production on the heels of what we heard from Saudi Arabia.
West Texas Intermediate 88.52. I was just a 90 print on American oil. We're not there yet. Would be really something as well. You got some movers today?
Yeah, I just wanted to take a look at some of the other stocks, and I really wanted to focus on the tech world. Oracle yesterday coming out and reporting earnings that were disappointing, in particular their cloud forecasts for their cloud sales. There had been such high hopes that it really explains why you're having such a significant drop, almost 10% at this point. It was 10% at one point, which would be, if it holds, the biggest fall since March 2020. Tesla shares off just a touch, but this yesterday after they gained 10% on the heels of a recommendation by Morgan Stanley analysts to buy the stock, that it was undervalued because of some of its newer technology. And then Apple, Tom, ahead of what we're going to hear later today, shares up 0.4%. I think it's important to stress when we're talking about incremental moves in some of these stocks, the market cap of these trillion-dollar behemoths really points to why we care. This is a significant part of the market. It's a significant part of the economic optimism that we've been hearing throughout the year. And it shows how little disappointments or little upside surprises can make massive swings in the share price.
Well, they do there. And again, the growth rate is all, and it's the revenue rate. And we need to make the distinction here before we get to Ed between Microsoft with growing double-digit revenues and Apple's not. I think a lot of people don't understand Apple's not delivering double-digit revenue growth.
That's not why the same, right?
This soiree today is important. Is that it? Are you done with your, fanboy market
keep
movers?
Going, but let's leave it there.
We'll leave it right there. Joining us on, this is really cool, Ed Ludlow with Bloomberg Technology. We bust his chops. He's not a fanboy. He's technologically a look at anything, including he knows how to pronounce Huawei, and I don't. But behind him, for those of you on radio, it looks like an ice rink, but it's not. It is the architecture of Foster and Partners, and it is a Steve Jobs Theater in the beautiful new Apple campus that they have out in Cupertino. In what way, Ed Ludlow, will Mr. Jobs be at this soiree this afternoon?
Because it's a pivotal moment for Apple to kind of prove that Cupertino knows what it's doing, right? Lisa makes the point that from a market or weightings perspective, Apple's really key, right? 7% weighting of the S&P 500. But they're also at the center of all of the headline and political risk that's going on with China. You are exactly right, Tom, that this is not a company growing at double digits. They've had 3 consecutive quarters of overall sales decline. But in the June quarter, it was a record for China. And that puts the iPhone firmly in focus because in China, in the June quarter, Apple swung to an 8% top-line gain from a negative 3% year-on-year gain the prior quarter. And what Tim Cook said, it was all iPhone. So then how do you balance the action by the Chinese government to clamp down in the public sector on use of iPhone, with Apple hoping that the upgrades of the iPhone 15 generation coming today is what's going to spur growth in that key market?
Steve Jobs, Ed Ludlow, don't let the noise of others' opinions drown out your own inner voice. Apple has been steely. Rumors of Disney and all this and all the other fanboy garbage that you and Caroline Hyde cover every day. What is the inner voice of Tim Cook right now?
The iPhone is everything. It's 50% of sales, more than $200 billion last year. And the criticism that they face is on the strategy of reserving the key technological updates for the higher end. So what we expect today is 4 variants of the iPhone 15, a base model, a 15 Plus, but then a Pro and Pro Max. And the strategy from them has been to say, we're going to keep our key upgrades to the higher end, raise ASPs, average selling price, and hope that that resonates in key markets if volume growth's not there. We know volume growth's not there. the smartphone market globally has had multiple quarters of decline, particularly here in the US. But one data point I point to, it does matter whether people buy the higher end phone. But while the overall market has retrenched in recent quarters, look at the market share data. Apple has been able to continue to grow its market share, even though the overall market's declined. And they're hoping that those higher-end technological updates today, which include a higher-end processor, the A17, titanium edges as opposed to stainless steel, and advanced camera technology, that will be tempting enough for consumers in a difficult market in China, but also here in North America as well.
Earlier in the show, Tom was talking about one more thing, and he was joking about this. And typically, this has been sort of how they're remembered.
Ed's got a tattoo of that on his
one more
left
thing.
arm.
It has always been the main thing. One more thing, the exciting thing that people are going to cling on to. How much of a one more thing is baked into some of the expectations for today's event?
Well, full credit to Bloomberg's Mark Gurman. You know, we know a lot of what's coming today due to his reporting. I think you guys talked earlier a bit about the charging cord wars. This is not the one more thing, but it is the thing that people will talk about, the USB-C, because it was mandated by the European Union. And it will be interesting to see to what extent Apple kind of claim it of a move made on their own volition or by their own volition, right? But it will settle debates across households globally. You know, there is no greater pain or challenge to the global consumer or electronics enthusiasts than the endless search of one's home to find a matching cable. And that may be settled today.
Well, okay, but that's not that exciting for people. Yes, it's exciting when it comes to settling some of the wars that happen frequently, but that's not exactly going to revolutionize the concept of Apple. How much do you expect them to start talking about artificial intelligence more materially after being so quiet in the hottest field of 2023?
I heard you talking to Mandeep Singh about this 24 hours ago. You know, Tim Cook and co have shown absolute restraint in talking about specific generative AI tools. You know, the line from Apple has always been that they have a long-standing competence in machine learning and AI. It is present in their software offering. All I can say is that will be a part of today's presentation, we understand, a later generation of iOS, but I expect them to show the same restraint about talking about AI.
Ed, one final question, because I know you got to get to the merch setup to get your Apple merch for this afternoon. The great surveillance to made of our guests is, will telephone, T-Mobile, and Verizon come to the rescue? Do you just presume with all your, you know, I'm serious now, with your serious reporting, are they going to do it again and competitively basically buy people's fancy iPhones?
Big part of the strategy here in North America. Go back and look at the questions on the earnings transcript about the support that Apple is expecting from the carriers. It involves heavily incentivizing the consumer. Because, again, we discussed it already, the strategy from Apple is to reserve the tech updates for expensive higher-end products. The carriers have to come in and offer packages in order to make it more accessible to a broader market. And how much pain they're willing to take to drive volume is at the discretion of those carriers. It's a fantastic question, and it's one that Cook gets asked about on the call often.
It's going to be fascinating today. We bust his chops about being a fanboy, but between Mark Gurman and Ed Ludlow, it is world class here at Bloomberg. Look to Bloomberg Technology this afternoon for our complete coverage of what fanboy is. Caroline Hyde fangirl? I don't even know.
I will not call them that.
Okay, I will.
I'm sure you will. I'll push back.
The fan duet will be with you with complete coverage of the silliness out in Cupertino, but it is a huge impact. I like somebody said today, maybe it was Lindsay Piegza, it's not a discretionary item anymore.
Yeah, exactly.
You know, it's a staple. I guess that would be the right economic phrase.
But an iPhone 15 isn't a staple. Maybe an iPhone 8 for a kid. I'm just saying, if anyone's listening in the household.
They're not listening. Trust me.
I know. No, I will say, though, that the idea of ending the cord wars would be a very nice thing, and not having to search for all of the little attachments and the right cord for the right thing.
The little attachment thingy always breaks. That's always the first thing to break.
Exactly. Or something gets in it.
I agree with you. You know, I guess it's a nuance, and we don't like the Europeans to tell us what to do, except Francine Lacroix. But the answer is, I agree with you that if we just get to a more streamlined USB, it's UBS-C cord. They named it after a Swiss bank. No. They named the cord after a Swiss bank. That's your input from Bloomberg Surveillance this morning. This market's terrible. We're going south.
Oh my goodness.
After Apple this afternoon, James Chanos will join, legitimate world-class short guy. This is Bloomberg. Stay with us.